Welcome. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith, and we are awaiting consumer price index data that should be coming any moment now. We're just waiting for these numbers here, but it was anticipated that we would see some moderation of inflation data, consumer inflation data, and we have it 0.1% month over month, excluding food and energy, 0.4%, and year over year. 4.0%. That's the headline. On a year-over-year basis, if you exclude food and energy, 5.3%. So all of these numbers coming in pretty much in line with estimates here. We did not see a slowdown on a month-over-month basis here in the rate of inflation, but neither did we see an acceleration. We saw a slowdown in the headline, but not in the core number here, which is the one that is more relevant. So that's what we're seeing writ large here. Brad, I don't know if we've had a chance to sort of go in and see any of the components. I'm looking at shelter prices going up, is what the headline here says, and used cars and trucks on the rise as well.
Yeah, as I'm waiting for my screen to refresh once again here, I did have the report up a moment ago. Shelter, the largest contributor to the move higher here that we'd seen month over month here. And, you know, just as we think about this in the broader context of where the Fed is continuing its own inflation busting, that's where, especially as their meeting begins and we eventually get that decision tomorrow, that we'll see exactly how they even look through this data as their meeting commences and what the tone and tenor of that conversation is. And as the report is actually loading back up here for me, I should have it in a second here as long as internet connection stays steady. But all that considered, when you look across some of the core items and where inflation has been stickier versus where in some of the discretionary items that consumers have started to push back and balk at prices and where those prices have started to come down, that is particularly interesting here. And as I have the report, index for all items, less food and energy, that actually rose 0.4% in May. Right. Did the same in April and March. And then additionally here, you mentioned the indexes that increased in May, including shelter, used cars and trucks, motor vehicle insurance as well, apparel and personal care. And then we're continuing to see exactly what the markets are doing. As of right now, it still seems like the futures are holding on to some slight gains for the Dow, the S&P 500 as well, fractionally, as we're seeing there on the screen here.
All right, so let's get some instant reaction, if we could, with Claudia Sahm, who is Sahm Consulting founder and former Federal Reserve economist. She's also the creator of the Sahm rule, which is a recession indicator that's used by the Fed. Claudia, good morning. Thanks for joining us. So looking at these numbers, it doesn't seem like we are getting any sort of meaningful core slowdown in inflation.
Right, you're correct. I would say, regardless of how these numbers came out today, surprise is like being better, the surprise being worse, we will all admit inflation is too high, right? The policymakers that have tools to bring inflation down need to keep going. Keep going may be to pause and wait and see how the effects of really big interest rate increases have been. But in general, this is not over. And I'd say the CPI is what means something to regular people. Right, the core is something the Fed looks at, but big picture, we have seen a lot of progress so far.
And so in the progress that we have seen from your perspective, Claudia, now moving forward, where do you expect that this perhaps has some type of weight in the conversation even today with the Fed?
Well, inflation would always have weight in the conversation, whether it's too high or too low.
Sure.
Because these numbers came in kind of largely as expected, it shouldn't change the path. And again, they have been very clear that they see inflation as too high. I do think we're getting to a point where the Fed starts risking doing too much. And we have seen some of the Reserve Bank presidents highlight that as a potential risk at this point.
Claudia, there's also been a lot of discussion about where the inflation is coming from at this point. For example, we talked with Paul Donovan yesterday of UBS, who said we're now in the profit-led inflation phase, if you will, where, it's not necessarily that companies are seeing such extreme input cost inflation at this point, but they're going as far as they can and raising prices to consumers. So if that is indeed the case, and you can tell us if you agree that that's the case, that also begs the question of whether the Fed raising will be effective in fighting that kind of inflation.
Right, and I agree that something that we've been looking at more and more is this price inflation. I mean, businesses, it makes sense. If they can raise the prices and they have enough customers, they're going to do it. The fact is that even customers who haven't been very price sensitive, at some point they say, no more, right? And businesses at that point have to back off. The other thing I would say that's really important and has dropped out of the conversation is we still have supply-driven inflation. Those used cars, that reflects too little in the new car business, and the used car actually shows up in parts of this super core, so the services ex housing, because we have car insurance, we have car repair, and those are some really sticky parts of inflation. Again, they're going to make the cars eventually, but we're not seeing it yet, and these are still problems.
You know, it's particularly interesting because I think there was a J.D. Power report out today actually talking about how in the car insurance landscape, you've seen that pushback from consumers, or you've seen that dissatisfaction, and it's starting to show up in other pockets too. So what do brands risk if they continue forward with the excuseflation, as some have called it, and over the long term perhaps damage some of the perception that consumers may have towards them?
Right. The best cure for high inflation is high inflation, right? Because consumers react. So what are businesses risking right now? They're risking customers. Now, in industries that don't have a lot of businesses, they can do this longer. And yet we are starting to see the signs of consumers saying, no, thank you. This is too much. And no longer appreciating this, well, it's supply chains, well, it's the war in Ukraine. Like, the excuses are running out to pull that strategy off.
Claudia, thank you so much for taking the time here as we continue to digest some of the numbers this morning. Claudia Sahm, who is the Sahm Consulting founder and former Federal Reserve economist. We appreciate it. Well, let's bring in our panel. We've got Rakeen Mahbood, who is the Groundwork Collaborative Chief Economist, Managing Director of Policy Research. Also with us, we've got Teresa Ghilarducci, Professor of Economics and Policy Analysis at the New School, and Danielle Twiss, an MA candidate from the New School. Great to have you all here with us in studio this morning.
Thank you, Brett.
So we've got the numbers here on the desk with us, and starting to really dive further into some of the details here. Rakeen, would just love to get your take off of some of the headline figures that we've seen thus far, and perhaps some of those pockets that really stick out from this report.
Yeah, I mean, to me, what sticks out in this report is the fact that, inflation is sticking around, and whatever the Fed is doing is not working. Mm-hmm. And the reason it's not working is because the tools that the Fed has to address high prices don't actually get at the core root causes of what's causing today's inflation. We have corporate profiteering, we have supply chain issues, we have geopolitical factors, and some of these issues have started to moderate. I mean, supply chains have started to ease, but the fact of the matter is the Fed, through its 10 consecutive interest rate hikes, and we'll see what they do tomorrow, have simply been hammering away at the labor market and really trying to weaken a labor market that has been remarkably strong coming out of the pandemic. And so I think we really need to take a different approach, and the Fed not only should pause tomorrow, but really pause going forward and see these 10 rate hikes play out.
Teresa, what do you think here? I mean, the Fed's traditional method of tamping down inflation is trying to tamp down demand. Yeah. Is that part working?
Well, I completely agree with you and with Rakeem. They're really operating on these very old theories, and also the present day fact that they're given some authority in a place where they don't have any tools or effectiveness. So they're given this huge hammer of interest rates. Interest rates for mortgages, depending upon the way you look at it, is the highest it's been in in a couple of decades. So they're hammering the housing market, but the theory says to hammer workers, hammer workers, hammer workers. This old idea that workers are pushing up wages, and then passively the companies just have to push up prices because what's a company to do. When in fact that's not happening. Last year, workers' wages was tight and did go up. We did see some nominal wage increases, but only 4.3%. Whereas prices went past that 4.7, 4.9, and we see it today. So workers are actually helping keep down prices because their productivity and their wages are helping companies be productive. So we're asking the Fed to do too much. They've gone too far. They've actually created some crisis in the banking sector. That was something their risk management officer should have figured out. Oh, what is a sudden rate hike going to do the balance sheet of Silicon Valley Bank? So for sure, tomorrow they should pause, and we should look at other sectors of our regulatory system that could help consumers and everyday people like Danielle.
Well, and Danielle, even within this, even as we think about some of those wages and how that's been factored into prices, I mean, it's important for us to remember too that wages are still well above where, at least in the growth, as that's starting to come down in wage growth, we're still seeing wages that are above some of the averages pre-pandemic times. And so with that, the prices, as businesses would say, they're going to continue to remain elevated as long as they can pass that through in a demand environment like this.
So I think the key thing is that prices are increasing at a rate that's higher than wages are. And wages started a couple years ago at a floor that was already too low for workers to afford their basic necessities in cities like this. And so when food and shelter, which is what workers are primarily spending their money on, are increasing at 6.6, 6.7%, and wages are seeing an increase of only 4.3, that's a real wage decrease. And so for working people, this is actually a decrease in their standard of living and a huge increase in their cost of living.
And I think people understand that sort of instinctively, even if they don't understand, right? They know that they know what's happening in their checking account, right? If they have a checking account, right? They know that they're getting squeezed when they're going to the grocery store, et cetera. We have seen something of an increase in worker negotiating power over this period of time. For the first time in a long time, we've heard a lot more union talk, for example. We've got the writer's strike, for example, going on right now. How long does that continue, Rakeen? How, if indeed the labor market weakens, do workers retain any of that power?
No, I think that is such a critical question. And just to double click on something that my colleagues have said, wages going up is a really good thing, right? People having more money in their pockets is a good thing for our economy. We all make the economy go. We should have more money. We keep the economy running. And we have seen over the course of the last couple of years, tight labor markets really bringing more and more workers into the economy. We saw 2 months ago, black unemployment drop below 5%, which has never happened in the data before. That is a remarkable achievement coming out of a pandemic. We have seen disabled workers, other marginalized workers really starting to see the benefits of a tight labor market. And with that comes an increase in power and agency and people able to demand what they deserve on the job, which is a good quality job, good wages. Look, the Fed is on a mission to destroy all that. That is the truth of the matter, right? They have put in 10 rate hikes into the system.
Well, but okay, to play the devil's advocate a little bit, to destroy all that, I mean, inflation is not helpful for people either. Non-wage inflation is not helpful for people either. And the Fed's mandate is to bring down inflation. So, wage inflation doesn't exist in a vacuum. You can say what you will about companies maybe taking margin, which is what publicly traded companies do. It's their mandate to do that to some degree as well. But, you can't, can you divorce, I guess the question is, can you divorce wage inflation from other types of inflation?
Yeah, no, you can't. But the Fed has to understand that wages and workers are not pushing up inflation, and they're smart, and I think they do, but they only have the one tool, which is interest rates. They're really hammering the housing market, and that's why today and last month we saw shelter prices increase so much. So they could take a pause to take a break on what they're doing to the housing market. I wish that tight labor markets were the only thing that workers needed to have some power. Yes, that brings in added workers, but for unions to get a wage increase that exceeds or even matches inflation, we're not going to see that anytime soon. The anti-union laws, are really hurting unions that might form in the new Inflation Reduction Act, the microchip companies, is mainly being built in the South. The big Taiwanese companies coming to Arizona, they're not organizing anytime soon.
And I think to get the full picture of labor unions at the moment, we also need to take into account this profit-led inflation, because when we have profit margins of 14, 15%, which is record profit margins that we haven't seen in decades, then if we look at this from a lens of class power, workers are actually in a really bad position. And so to me and to other people that I work with in union organizing, the solution is actually increasing worker power. So to combat inflation that's profit-led, that actually means more worker organizing and more worker power. That's the solution.
I want to thank you all. Unfortunately, we have to leave it there. Thank you so much for being here. Rakeen Mahbood is Groundwork Collaborative Chief Economist and Managing Director of Policy Research, Teresa Ghilarducci, Professor of Economics and Policy Analysis at the New School, and Danielle Twiss, an MA candidate from the New School as well. Thank you all so much. Really appreciate it. We'll be back at 9 a.m.
Former President Donald Trump landed in Miami earlier this afternoon. He's set to face criminal charges of unlawfully keeping U.S. national security documents, as well as lying to officials who tried to recover them. Here for more on that and also what to expect next, we want to bring in Nick Ackerman, former assistant U.S. attorney of the Southern District of New York, as well as a former Watergate prosecutor. Nick, it's good to see you. Certainly, many people obviously have not been holding back. We heard from former AG Bill Barr over the weekend. He called this indictment very, very damning. I'm curious, just from your perspective, how serious this case is and how strong some of these allegations are that are outlined in this indictment.
One, it's very serious, and two, the case appears to be very strong based on the evidence that's outlined in this indictment. And the indictment basically takes Donald Trump through the theft of the classified information from the White House that he kept unlawfully at Mar-a-Lago, that he used in a way that is not even permitted. They've got him on tape using one of the documents to go after General Milley, the chairman of the Joint Chiefs of Staff, and acknowledging on that tape that he had no ability to declassify that document, that it was still secret, and basically obliterating all the defenses that his attorneys have made over the course of the last couple of months, including defenses that he's made as well. And then you take into account the fact that he essentially hid 30 boxes of documents from his own attorney, who was charged with the duty of going through the documents to respond to a grand jury subpoena. And Trump was assisted in this whole project by his assistant, Mr. Nauta, who's also charged as a defendant here. This lays out evidence that is extremely serious and shows that Donald Trump had a total disregard for protecting classified information, keeping it in his bathroom, his shower, putting it in the ballroom at Mar-a-Lago. There's basically nothing good that comes out of all of this. And it seems like a case that's pretty straightforward. The star witness is going to be Donald Trump because they've got him on tape. They've got lots of witnesses who are going to testify as to what Trump did. This should be a pretty open and shut case.
So, Nick, Diane here. Former President Trump has maintained his innocence throughout this. And one thing that didn't show up in terms of the indictments, there wasn't any reference to kind of any business efforts to profit from this information. Does that help in his defense in any way?
Well, let me just say, what you're talking about really is the motive. Why did he take this stuff? Why did he go to the lengths that he did to keep the government from actually getting it? So that all is motive. And motive is not an element of any of the crimes here, but it does give color to what he did and to the seriousness of what he did. We do have some hints at that, where he basically was using it against General Milley to make a political point, basically Trump's idea that he's his own retribution going after General Milley. But we also know that the prosecutors were looking at other angles. They subpoenaed records from the Trump Organization on 7 foreign countries that most likely relate to some of those classified documents. And it's very possible that this kind of information and evidence is going to come out at the trial, simply because there's really not a necessity to put this into the indictment. So we don't really know exactly what this proof is going to be. And I'm sure when the trial comes along, we're going to see some surprises.
Nick, there's still a search underway for an expanded legal team. Give us a sense just of what that process is like, what the timing of that is like, and how that could potentially impact the timeline of this case, if at all.
Well, it's going to have to be pretty quick. If Trump got rid of 2 lawyers and now he's got to get other lawyers, they're going to represent him in Florida. If I were the judge, I would just make sure this is done post haste. If I were the prosecutor, I'd be trying to get this to trial in a couple months, basically providing all the discovery as quickly as possible, trying to get the judge to set down a very short motion schedule and get this to trial. I mean, this is a simple case. Most of the evidence Trump is already aware of. And so there shouldn't be a lot of dragging the feet here. This should get to trial immediately.
So, Nick, I got to ask you, in terms of, it does seem like the evidence is pretty strong. And if this does go, not the way that President Trump would like it to go, I mean, he is still running for office again. What is the fallout from this? I mean, he can still proceed with that, correct?
Oh, sure. I mean, there's nothing in the Constitution that says you can't elect somebody who's in prison. The only qualifications are you've got to be 35 years old and born in the United States. But I find it hard to believe that he's going to last long in this race. We now have 2 indictments. We know that in late July, early August, when Fani Willis in Fulton County brings together the next grand jury that's going to indict on her case, that's going to be a blockbuster indictment that's going to charge Donald Trump and a number of other people with respect to interference in the presidential election in Georgia. And it's also likely there's going to be a 4th shoe to drop with Jack Smith with the January 6th matter that he is also investigating. At the end of the day, it's very hard to believe that the Republican Party, senators and members of the House are going to want to run for re-election in 2024 with the head of the ticket under indictment in 4 different cases. All of these cases laid out in detail in the indictments that just are not resume builders for Donald Trump. It's not going to appeal to the independents that a Republican nominee has to win over in order to take the White House.
Nick, the judge that was appointed to this case, at least for now, Eileen Cannon, appointed by Trump. There's also some attention that has been drawn to a recent ruling that she made pertaining to Trump. What kind of challenges from a former prosecutor standpoint, does this potentially pose here to the prosecution team?
I don't really think it's a big issue. Look, she made a mistake. She screwed up in terms of ordering a special master, which she shouldn't have done. She was looking at what happened in two other cases in New York with two of Trump's lawyers, Rudy Giuliani and Michael Cohen, where the judges had ordered that there be a special master. But in both of those cases, there was a good reason to do it because there was lots of potential privileged communications because both of those individuals are lawyers. Look, judges make mistakes. She was reversed by the 11th Circuit. They made it very clear to her that Donald Trump is not to be considered in any kind of special status because he's a former president, that he's to be treated just as any other criminal defendant in the federal court system is treated. And I think that she's learned her lesson. I mean, at the end of the day, and let me just say this, I mean, a lot of the judges that Donald Trump appointed, I mean, none of them have really provided him what he wanted, including the U.S. Supreme Court that didn't uphold any of his cases based on the big lie that the election was stolen and rigged. All of those cases were dismissed, a lot of them by Republican judges. And if you go back to Watergate, the same thing happened. The judge who was in charge of the Watergate case, Judge Sirica, was a Republican appointee. He's the one that essentially set up a situation that caused the Watergate burglars to come clean and cooperate against higher-ups in the White House. And the Supreme Court, many of whom were appointed by Richard Nixon, wound up deciding unanimously to order Nixon to turn over the Oval Office tapes. Bottom line, at the end of the day, I think it's better for our system, better for the judiciary, that Donald Trump be tried in front of a judge that he appointed, that he be convicted, and that people realize that this is a serious case with serious consequences, and it has no politics in it whatsoever.
Trump set to appear in federal court tomorrow, Tuesday, in Miami. Nick Ackerman, great to have you. Thanks.
Good morning. It is 9 a.m. here in New York City, and this is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are the three things that you need to know to start your morning. Inflation and headline inflation showing a slowdown on the month, but that core figure coming in flat at 0.4%. That number, which excludes food and energy, is the one that the Fed tends to focus on. The report comes as the Federal Reserve begins its two-day meeting. It's widely expected to pause its 18-month rate hike campaign at tomorrow's decision. Messaging from the central bank has been scattered as of late, though. Some officials advocating for patience as the lag effect of hikes still feeds through. And Oracle shares, they are jumping, as Destiny's Child would say, in pre-market trade. After fiscal fourth quarter results beat the street on the top and bottom lines, cloud computing rocketed 54% on the year, driven by demand for, you guessed it, AI. Growth in Oracle's cloud infrastructure segment is now outpacing offerings from peers, including Microsoft and Google. The business has been gradually boosting its AI cloud offerings, most notably in its tie-up with NVIDIA, perhaps the biggest beneficiary there of the trade towards the technology. Oracle shares are no slouch this year, though. They're up over 40% in 2023, beating out the wider S&P 500. And China is said to be considering more monetary stimulus after a surprise rate cut. The nation's central bank slashed a key short-term interest rate amid growing concerns over a prolonged growth slowdown. According to Bloomberg, additional measures could include steps to support the struggling real estate sector. Property stocks in Hong Kong rose on the news. The move to loosen policy goes against the grain, with most other global central banks seemingly staying the course on tightening to battle inflation.
Well, it's a busy few weeks ahead for global central banks. The Federal Reserve, of course, is expected to pause interest rate hikes during its upcoming policy meeting on Wednesday. The Bank of Japan is making a decision later this week, and economists expect them to not make a change on rates. The European Central Bank is expected to raise interest rates by 0.25 percentage point next week. So a lot of central bank activity. As we look at today's U.S. CPI print showing core inflation remaining sticky, investors are curious to see what the Fed does next. For more context on the numbers and what the Fed's next move might be, we're joined by Chris Harvey, Wells Fargo head of equity strategy. Chris, I was looking at headlines that the year-over-year number is around the slowest it's been in a couple of years. But this number doesn't feel like we know what the Fed's going to do tomorrow, I think, right. But it doesn't seem like it's a very reassuring number on the inflation front.
Yeah, Julie, I think that's right. I think the word we're going to use is you can't say mission accomplished. The Fed still has to do more. And if you look at the Fed, we're looking at a situation where we haven't broken the economy, right? The job market's still incredibly strong. Inflation is stubbornly sticky, and they're talking about a pause. We really do think they need to do more. And more may be holding on, but more may be more interest rate hikes as we go forward in time. Things, if you told me that Fed funds were going to be above 5% and the economy would be doing what it's doing right now, I'm not sure I would have believed you.
And so for the Fed right now, even as much as they are continuing to do their inflation busting to the best ability possible, where that inflation is also kind of remaining sticky comes to another point in their dual mandate on the employment front, right, where wages are still a concern and how that is factoring in to prices perhaps.
Well, wages have been slowing down, so they've been coming in less than expected, and that's good, right? And the job market still remains pretty strong. So I think on that side, their dual mandate, they're still pretty good. But really the inflation side, they're talking about 2%. And I think 2% is really aspirational. Can they get it down further? Yeah, I do think they can get it down further, maybe with time, but really I think they need to do more on the interest rate side. And I'm a little bit surprised that they're pausing at this point in time, because again, if you had the equity market up 10%, the economy where it is, the job market is strong, I wouldn't expect the Fed to be pausing. But you're right, they signal that. I should expect this pause. We should all expect that, and let's just watch the numbers and see what happens.
Yeah, they don't like surprising the market, as we know. I mean, and they're allowing sort of this percolation, right, of the rates to make their way through the markets, I guess. So to your point, we have seen stocks just stage a pretty impressive rally, right? We've seen new highs for stocks like Apple. We've seen a new bull market, et cetera, et cetera. Right. As you said, this was difficult to predict, right? Especially the economic backdrop here. Right. So how do we predict what happens next?
It's a great question. So let me be incredibly transparent. We're at 4,200, so the market's above where we expected it to be. That was our year-end price target. We're very surprised we got here this quickly. And then when we look at the underlying fundamentals, they really don't justify this kind of sharp move up. A lot of it, as you know, is AI and AI related. A lot of it is positioning. And so as we look forward in time, we think it's a period where you should expect to see some sort of pullback. So couple of things that we think make sense. This rotation into smaller caps and mid caps, that makes sense to us because they've lagged a lot and you think the economy is still okay. Well, we should see a bounce, and we are seeing that bounce. And again, Uber caps have done an incredible job year to date. The other thing, though, that we think is nothing goes up in a straight line. And so at this point, a lot of my peers have gone from bearish to bullish. Sentiment has really risen. We're going to start looking at 2Q numbers in the second half, and things aren't great. So sooner or later, we should have some sort of pullback. We also have to deal with what may be a not so great decision, or we may be dealing with a situation where students have to pay back their student loans in full. And that's not something I think a lot of people are expecting, especially people who are on the other side of that trade, if you will.
Certainly. And so 4,200 before as well, we should note the Q3 2023 beginning of a recession that some bank CEOs have called for, or at least anticipate or forecasting right now. So what does that signal to you?
So again, like all good equity strategists, I'll talk my book a little bit. So we were expecting an economic malaise, and we were expecting economic malaise because the consumer was in pretty good shape. Balance sheets were okay, right? We're talking about the consumer whittling down his or her excess savings. If you look at the corporate side, corporates were in good shape. Fair amount of cash on the balance sheet, margins pretty healthy. But what we thought is you had a lot of pent-up demand being satisfied, and there's just no real upside. We did think for a moment, especially with the banking crisis, that something bad would happen that would push things over, but that seems to be satisfied. And so what we're beginning to see is more and more people just saying, hey, this is going to take a lot. We'll get there, but this is going to take longer. And that does make sense to us. But again, what we're dealing with is the capital markets move a lot faster than Main Street, and the capital markets have moved very, very quickly year to date. So it makes sense to at least have a pause, if not a slight pullback.
On the flip side, what would convince you that the rally in equities is real, for lack of a better word?
So let me say it this way, okay? The way we're wrong. I think there's two ways that we're wrong. That the premium for AI is even higher than we ever would have expected, okay? The other way that we're wrong is there is no recession, right? That we just kind of muddle through, inflation comes down, and the Fed realizes that monetary policy is actually too tight, and they need to cut not because the economy is slowing down, but because inflation has come down and monetary policy is too restrictive. And all of a sudden, everyone gets very excited about that. Interest rates come down, and you can support a much higher multiple, and EPS numbers begin to go higher. So those are the two scenarios I think. We just have a very difficult time with that recovery, that soft landing. And without really high EPS numbers, with the multiple that we're looking at, 19, 20 times, it's just hard to get really excited about the market. I'm not sure what we're playing for at this point in time.
All right, Chris, stick with us. We do have much more to discuss here, but in the meantime, we got to talk about shares of ORCL, Oracle. They are extending gains today after closing at an all-time high on Monday. The software giant beat on earnings and guidance, reporting a jump in cloud revenue driven by AI demand. And
imagine that.
I can't imagine. My goodness, the shocker, right? And as they were talking about on the call, you heard from the CEO, Safra Catz, saying, I think we're at about the middle of the beginning, looking ahead, seeing more growth opportunities that should help power the future growth acceleration in the future. And what did they say specifically around AI? Exploding AI demand, their words, leaves them with some significant upside, they said on the call.
So I think the real key here in this latest phase of companies talking about AI is what are the exact numbers around it? Yeah. That's what the street wants. That's why NVIDIA had such a leg up. If NVIDIA says our revenue is this specifically because of AI, and that's what Oracle did as well. So Oracle cloud sales overall were up 54% to $4.4 billion. But specifically here, the chairman, Larry Ellison, saying in the statement that more than $2 billion in cloud capacity has been contracted by companies doing large language model development, the likes of which power things like ChatGPT. And he named some of these companies: Mosaic ML, Adept AI, Cohere. So again, here is a concrete example of where it is actually bringing in sales related to this. Speaking of Cohere, by the way, Oracle has a big investment in Cohere as well, which is one of these other big developers of large language models or generative AI or whatever you want to call it.
Yeah, and even for the shift that we've seen in terms of messaging swiftly and how companies are talking about AI and full-throatedly, they are also thinking about, all right, how has our business changed dramatically from not just the products that we're selling, but how we are looking to be more of a subscription business. And I look across some of the subscriptions that, of course, companies like Oracle, like SAP, like Salesforce, like we continue to hear about where their subscriptions are, even as you're in an environment that they had talked about coming to this year of increased deal scrutiny. Now, it sounds like the demand that they're seeing from AI might be outpacing some of that deal scrutiny. However, it's important to still be tracking some of the subscription bases that they're giving us
Don't
forward
forget
here.
about the rest of their business.
The rest of
in
their
other
business,
words.
right. Cloud services, license support revenue, that actually grew by 25% for them. So considerable growth there that they were seeing in the other parts of the business that investors and analysts still had to keep an eye on, regardless of how much they got on the call and decided to talk about artificial intelligence, which they did, and they did that well. So, thinking through all of the other areas of the SaaS model that they have, kind of annualizing revenue in their strategic back of office SaaS applications, about $6.6 billion, growing there by 24%. You're seeing growth in the other segments of the business at the same time, while you're seeing some of the new demand that's coming forward in AI really give them a new, perhaps, leg to stand on too.
Yeah. Well, let's broaden out this AI discussion here, because as we've been talking about, the S&P's bull market has been dominated by a few mega cap stocks, what Chris just called Uber cap, driven by enthusiasm around AI. But with the dot-com era as an analog, how does the current rally compare? In today's morning brief, I put the tech boom in the late 1990s and early 2000s up against today's AI climb with the help of Keith Lerner, of Truist, who was on with us yesterday. And as Keith pointed out, the current peaks have yet to reach the heights of the tech bubble. If you're looking at the returns, the 1 month rolling returns near the peak of the dot-com bubble, 113% for tech in the S&P 500. Right now, it's about 27%. So in other words, we have not run as far. He also found that if you're looking at big tech right now, around 26 times forward earnings for the S&P Tech Index, it was more than double that during the top of the dot-com bubble. So that's the question about whether that's going to help lift us things. And so let's continue that discussion and bring back in Chris Harvey. Chris, so what do you think here?
It's true. So let's kind of look at what's similar, what's different, right? What's different? Okay, back in the late 90s, it was the Wild West. You didn't know who the winners were. Today, you really do know at least the initial round of the winners, because AI is a scale and size business, because it's a lot of your cloud players, it's a select number of semis, and it's your data centers. The second thing, let's just talk about valuation. Valuations are very, very different between today and then. And also the way that stocks are moving. Back then, as you recall, or you may recall, people were trading on eyeballs and clicks, things that just didn't make any economic sense. Here, we're actually seeing real earnings and real earnings growth, right? But what's similar, or what could be similar, is what really was the beginning of the end in the dot-com era. And what that was is we did have in 99, 2000, we did have the Fed tightening monetary policy. And what that did is it weighed on the economy, it weighed on the old economy stocks, and ultimately that was the beginning and the end for the new economy stocks. And what are we seeing today? We're seeing a Fed that's tightening pretty aggressively. What's happening is the economy is in an economic malaise. Some people are talking about recession, but I think economic malaise is the right word. The older economy stocks are the ones that are lagging, and the newer economy stocks are taking off. So I think that the similarity is kind of the theme with the Fed, but if you look at valuations are nowhere near where they were back then. The underlying fundamentals are much better today than they were back then, and the application of AI is in the here and the now. It's not 12, 20, 26, 36 months down the road. And so it makes it a very different type situation. And so if you want to talk the bull case, you really can talk the bull case. It's just, how do you get there? And again, our issue is that you've put a lot of the good news there. The top 5 names in the S&P 500 on average are almost up 50% year to date. That's a heck of a move. Valuations for the Uber caps, yeah, it's still pretty reasonable. Can you see some upside? Are there growth opportunities? Absolutely. Yeah. But we just think you need to pause right here, right now.
Chris, usually after the show, I go back up to my desk. I'll listen to Beyonce's Renaissance for the umpteenth time while I do some other work. Yesterday, instead, I listened to Salesforce's AI Day. And actually, Yahoo Finance's Brian Sozzi spoke to Salesforce CEO Mark Benioff about the AI boom. Let's hear what he had to say.
Well, we've seen a lot of exciting waves of technology in our industry, the cloud, social, mobile, but this AI wave is going to be the biggest that anyone has ever seen. I think that the success of OpenAI is the point of evidence that this is going to be one of the fastest growing moves, not just in the consumer market, but in the enterprise market.
So what does that look like in terms of stock performance perspective, if it is the fastest growing part of this holistic sector?
Right. I think you've seen a lot of it. So most of the stocks that are doing well are AI related growth stocks. And I think that's going to continue. But what we're also looking at is who are the companies that are instituting AI and benefiting from that? And we're seeing a host of companies you never would have thought of. So we looked at Kraft Heinz. Kraft Heinz is saying we're using AI to optimize our supply chain, to get things on time. You're looking at a Best Buy, they're talking about how they're using it in customer service. Some of the hotels are talking about how they're using it to predict RevPAR and how it does a better job in predicting RevPAR than many other aspects. So we can talk a lot about how the growth opportunities on the tech side, but there are also a lot of opportunities just in your more mundane type operations. And so I do agree, this is one of the most innovative technologies we've seen in the last 2 years, and we're only just scratching the surface, I believe.
Yeah, to your point earlier, though, how much is it worth, I guess, is part of that. So sort of related to what you were just saying about all these other companies, I am curious if you're looking at some of these mega caps or uber caps as too expensive right now, where in the market is attractive to you?
So where's attractive? We still like growth. We like mid-cap growth. It's underperformed on a multi-year basis. It's underperformed year to date. It's beginning to bounce back. And we think growth is the place to be because we do think you're going to be in this economic malaise for some time. So we want companies that can have self-help. But if you look at the multiple on mid-cap growth, it's 16 times. And so you could see multiple expansion as well. We think it's one of your better risk rewards in the marketplace. And it's beginning to work right here, right now. It's not that we hate the Uber caps, we just think they're overbought. They need to take a pause or some type of pullback to uncover a little bit of value. But if you're asking what we like in the here and the now, best risk reward, it's mid-cap growth because of valuation and the growth opportunities.
What's the benchmark by which you would mark it and say it needs to be real by this timeline for some of the AI discussion, for even what I was watching yesterday with how Salesforce was educating me on, the prompt that you'll give a generative AI tool and the result that you get out of it, how it makes things quicker. Right. Is this not real until the end consumer, and every day, like a grandmother is out there being able to engage with AI and essentially have real-time results and feel like they're more productive?
Okay, so my mom is a grandmom, and she is talking about AI. The other thing I would say is you are seeing, so I have a little guy, I have a 10-year-old playing lacrosse. One of the dads has a camera, brings the camera and it's attached. There's a bunch of AI packages surrounding this camera. It follows the kids, and then after the game, it creates clips and statistics and everything else. You are seeing it real time. So when you ask, hey, do we know it's real? It is real. We're seeing it show up in a lot of the tech company earnings. The issue that we have is when we talk to more of the old economy stocks or the old economy CEOs, they're not giving us a lot of information of what the costs are, what the benefits. They're giving us examples, right? RevPAR examples, supply chain examples. They're talking about how we're optimizing our access to, if you're an energy company, to different sources of power, but we can't get the hard numbers just yet. So we'll get that, and I think 2Q numbers will reveal a lot of that, or will give us a lot more information at this point in time. But we are seeing it in the here and now. And again, this is one of the things that makes it different than the late 90s, is the commercial application is in the here and the now, and the adaptation is very quick, and the acceleration is going to be like something we haven't seen before.
I got to get that camera that you're talking
about. Yeah, I know, seriously. Chris, stay with us for a hot second here. We have to switch gears internationally now. China's attempts to boost its economy have drawn little enthusiasm from investors. Trading volume was low, even after the People's Bank of China announced an interest rate cut today, and news of potential stimulus had minimal effect on markets. Investors had high hopes for China. The economy was expected to spring back to life after a tight COVID lockdown. But the market has steadily declined, entrenched in a bear market for more than a year. China's roar back has been more of a bit of a whimper here. So how will the nation's push to fuel economic prowess affect other world markets, including our own? Back with us, we've got Chris Harvey, who is the Wells Fargo head of equity strategy. So how does this show up in the numbers for U.S. companies that are also looking at China's economy and for their relationship with consumers or contracts there with other businesses where they were anticipating that this could be a net beneficiary for them?
Yeah, so let's take a step back, right? A lot of investors played the reopening of China. They thought, hey, this is going to be great, this is going to be fantastic, and people did make a lot of money. But the problem is that that reopening didn't translate into something bigger, broader, which is why China is now talking about the stimulus. It's unclear if the stimulus is going to work, right? Is it going to filter back into the capital markets? Yeah, I think at the margin, it adds liquidity. It's going to add a little bit more on risk-seeking, risk-taking, but it's still a big question mark. And one of the things that we've been talking about since the end of last year is the U.S. consumer had gorged on goods, right? What does China do? It produces a lot of goods that we buy. And so as a result, what we're seeing with the U.S. consumer is a change from goods to services. That's not real positive for China. That's one of the things that people aren't really talking about, and something that you really can't fix with stimulus at this point in time. But to answer the question, I think the stimulus will be helpful. I think it will be positive, but really it's just a marginal issue. As we've been talking about all morning long, it is really about AI. It's about the adaptation of AI. It's about the Fed and Fed policy, and what's happening in China is nice, and it seems like it's going to be a positive, but it's not a real big factor in what we're seeing right now.
I mean, how concerned are you about, for example, U.S. companies that are quite dependent on the Chinese market? I mean, more in Europe, but we've been watching the European luxury companies that have really been falling and rising as we've been getting headlines out of China.
Yeah, so we are still worried about the Chinese economy. We are still waiting for it to accelerate. And companies that are tied, their end markets are tied to demand in China. On the consumer side, I think it's okay. But on some of the bigger picture issues, I think it's a wait and see. It's not clear what's going to happen, and that economy has been struggling for some time.
All right, Chris, we're going to take it back from China and focus squarely here on the United States and bring in one of our reporters to help with that. Former President Donald Trump faces a 37-count indictment for mishandling classified documents. Investors are left questioning how to price in the aftermath or maybe a possible second term. Yahoo Finance's Rick Newman is joining us now. Rick, you wrote about this because this is something we've sort of been grappling with, right? How should investors be thinking about this whole situation?
Right. Trump's legal problems don't affect markets right now, but look at what's happening here. So he actually remains the Republican frontrunner. He says there's no way he's pulling out of the race, no matter what happens with any of these charges or these different legal cases against him. And his approval ratings actually went up a little bit among Republicans, according to polls conducted after those charges were revealed last Friday. So let's say Trump actually becomes the Republican nominee. Try to get your head around this one. So let's just talk about the federal case. That's one of what could be 4 legal cases. Think about this in 3 different parts: a trial, sentencing, and an appeal. It is quite possible that this trial will actually be ongoing in the weeks leading up to the election in November of 2024. So let's say the trial is conducted. Let's say Trump is found guilty in this trial, which many legal experts say seems very plausible. We could have a convicted presidential candidate who has not yet been sentenced, or we could have the trial ongoing as of Election Day. So if Trump really is the nominee, how in the world do you price that in when you're trying to figure out what Trump's policies might be if he actually gets into office? And then there's this surreal possibility that he would govern from prison. How do you figure that one out? So we're not there yet, but this is going to get crazy if this goes the way it looks like it might go.
Rick, I guess for the best correlated kind of equity market asset that's out there that people would immediately annex to anything President former President Trump. It's Digital World Acquisition Corp, I suppose, and shares of that, yeah, sure, they've been hit hard over the course of the year, but we've seen some slippage even over the past month. Is anything that we see in activity for a ticker symbol that is closely annexed to the former president, is that applicable to anything else in the broader markets?
I guess you would have to think like that. Digital World, DWAC, that's, of course, a very, very small company. And that company is facing legal issues as well over whether that SPAC deal was actually they played by the rules. But I think if you go back to how the market had to think about Trump in 2016, that gives you some idea. So it was a surprise when Trump won in 2016. And just to remind people, what we saw in the market was on election night, after the markets had closed here in the United States, U.S. futures and overseas markets nosedived when it became apparent Trump was going to win. But then the day after, stocks actually went up because investors were like, oh, yeah, he wants to cut taxes. He wants to cut regulation. And at the same time, so investors like that, but they did not like what he was saying about trade wars and tariffs and protectionism. So I guess you would be thinking about that kind of stuff come Election Day 2024. But Trump also is talking about a few different things. Like one of the things he wants to do is slash the federal bureaucracy. I mean, like cut the federal workforce in half. He's angry at the federal workforce. He also is talking about stuff like let's stop aid to Ukraine. That would have massive implications for global energy markets, for example. Would he withdraw sanctions on Russia? Again, large implications for energy markets and other things. So this is quite a Rubik's Cube of policies you'd have to sort out. We're not there yet, but boy, this really gives you something to think about.
All right, Yahoo finds his own Rick Newman. Yeah, plenty to think about and to chew on for quite a bit of time here. Thanks so much, Rick. Appreciate it.
Hi, guys.
Well, for more on the political implications, let's bring back in Chris Harvey, Wells Fargo head of equity strategy. I mean, Chris, in your equity strategy and, your day in, day out.
Chris I'm just watching Chris's face.
I'm waiting for it.
Where does this even, what percentage of the considerations during the analysis and looking across the markets and scanning what's really taking place under the water would you say that this takes up?
This is a very, very small percentage in our day-to-day, right? It makes a lot of headlines. It causes a lot of back and forth, a lot of banter, makes some people happy, some people sad. But at the end of the day, does it affect monetary policy? Does it affect the application of AI or the acceptance of AI? Does it affect inflation or things that are driven by the capital markets? Money coming in, money going out? No. It really just doesn't have, in our view, a big effect on the capital markets. It makes for great TV, it makes for great news headlines, but at the end of the day, it's not a driver of stock price, multiples, earnings, inflation, things of the such.
Over the longer term, right? I mean, I think when you're looking at the various policies, once someone gets into office, the tariffs, for example, you could argue were a driver of, on corporate balance sheets, but we don't really know yet what we're going to have on that front.
We don't know who's going to be the winner or the winner of the primary, the GOP primary. And so what we're doing is we're speculating about speculation. And that's just not productive at the end of the day. And it's really to handicap something like that and try and tie it back to stock prices and multiples, not something we're doing and not something I really see influencing the market or the marketplace. It just makes for a lot of headlines, a lot of talk, a lot of banter, a lot of speculation. We will eventually get closer to finding out who's going to be the contender to what appears to be Biden. But until then, we're really going to focus more on the fundamentals, the monetary policy, and fund flows. I think that's a lot more of what's going to drive capital markets and going to drive opportunities.
Is it just logjam from here until the 2024 general election?
Logjam,
and thus taking, perhaps even in that scenario, taking Washington out of the equation, it is just focusing in on what you mentioned a moment ago.
Yeah, so the big issue for Washington was the debt ceiling.
Yeah.
We did get the debt ceiling done. And now, as we look forward, on the macro front, I think the other big issue is we're going to get a Supreme Court decision on student loan forgiveness. Okay. I think that's probably the most important thing that we're going to see. That has little to nothing to do with Congress. In the debt ceiling, they did say that you do have to pay back your student loan. I believe it was the end of August, maybe beginning September, but that was going to happen anyway. Right. The biggest decision is that student loan forgiveness, and I believe we're going to get that answer by the end of the month.
Unless President Biden somehow manages to get something through Congress on that front, but that's probably a
there was some language in the debt ceiling saying that unless it's emergency, you can't put a moratorium back on. So I think they've really tied his hands.
They would have to write something entirely new.
Yes.
Yeah. Chris, thanks for being here. Thanks for playing ball with some of these questions. Appreciate it. Chris Harvey, Wells Fargo Head of Equity Strategy. Really appreciate it. We just had the opening bell on Wall Street, so let's do a quick check on the markets. And we do see them pushing higher, particularly the Nasdaq up 0.7%. Of course, we did have the CPI data this morning coming in on the headline lower and slower than estimated month over month, although the core inflation is still proving to be sticky, as we have been talking about. Bond yields moving a little bit lower in the wake of this, and that's perhaps fueling that outperformance of the Nasdaq this morning. But let's dig into it a little bit more. For that, Brad Smith, look at that. The Interactive's cooperating with you.
Oh, man, we love the Interactive. The Dow Jones Industrial Average, as you're seeing here on the Wi-Fi Interactive, that's up by about 0.1% over the course of this year. Yeah, we're giving you a year-to-date. Well, that's a 52-week view. Let's give you a year-to-date view. That's up by about 3%. We'll be generous and round it up to today. Why? Because we're feeling generous. The Nasdaq Composite, you're seeing that up by about 0.7%. Year-to-date, of course, big bounce back for some of those tech stocks here, and that really driving the Nasdaq Composite to be the outperformer in terms of the major U.S. averages, at least the big three here. The S&P 500, you're seeing that higher by about 0.4% here on the day out of the gate. Year to date, still seeing gains and holding on to gains of about 13% there. Since we mentioned the S&P 500, let's take a look at some of the sector activity that we're seeing within that average. And as I'm just kind of toggling over to that, 11 sectors, we've got them loaded up here for you on the screen. As of right now, that's a year-to-date view, and yes, there we're seeing energy actually leading the charge on the day. That's up by about 1.2%, bringing up the caboose though. XLU, utilities, all right, that's down by about 0.6%. So all in, you do have more gainers than laggards as of right now. And then lastly, we'll ride out with a quick look at the Nasdaq 100, where you've got some major mega cap tech stocks largely holding on to positive territory. However, Apple moving off of that record high that we had seen that came yesterday here, but as of right now, only down by about 0.3%.
And I just saw a headline that it looks like Oracle's at a fresh intraday high here in the wake of that company's earnings. We've been watching those shares move up, but I'm not seeing them up there as of yet. So we'll have to find them somewhere.
Yeah, I'll keep looking around.
Yes. All right. We'll look at that. And we'll look at, speaking about mega caps, Apple stock continues to defy expectations. The tech behemoth reached a record high at market close Monday, but now it's taken a little bit of a hit. We'll tell you why next. Let's get a check on shares of Apple. A day after the stock closed at a record high, the shares are pulling back slightly in today's session, and that's after perhaps just taking a pause, but also got a downgrade over at UBS. The analysts there moving to neutral from overweight and basically saying soft demand trends are to blame for that, but also pointing out that the stock is trading at a 50% premium to the market. So this sort of similar, I guess to some extent, to what Chris Harvey was just saying at Wells Fargo, right? Is that it's not necessarily that some of these mega cap stocks are not going to grow. It's a question of what you're going to pay for that growth and is it worth it? So that's really, I think a lot of people in this market are grappling with that right now.
Yeah, just looking at how far the prices come. I mean, we're just moving off of a new high, intraday high, and for Apple yesterday and the activity that investors, even over the past week since the announcement of the Vision Pro, when they had their big WWDC that our own Dan Howley was at, we were monitoring the stock price reaction, watching it get to or get in that ballpark of $3 trillion here. And so now the larger question is, all right, at what type of growth can this company continue to impress investors? And for the areas that have already shown some type of pushback from consumers, where that's on the electronic and discretionary side of their purchases, PC demand, that's not going to change dramatically in the near future, it doesn't seem, even though they have announced the new MacBook Pro that we were able to get hands on here on set yesterday. The iOS and the new updates there, sure, they look great, but at the end of the day, the iOS is going to be rolled out to an install base that they already have, and the number of new devices that are going to come online, that's still kind of up in the air right now.
Yeah.
And so you're still looking for a super cycle that has not emerged as to when that timeline is going to begin for investors to hang their hat on that next leg of growth for Apple.
Yeah, it's interesting, this note, because David Vogt, the analyst, is still raising his price target, even though he's downgrading the stock to $190. It's just above $190, where Apple would be a $3 trillion company. And if you look, even as it is, at the market cap of Apple, you know, sort of this puts it in perspective. We talk about these giant stocks and how they have dominated the market here. This really puts that in perspective. So there you have Apple's market cap at around almost $2.9 billion, bigger than Microsoft, bigger than Amazon, bigger than Alphabet, bigger than Saudi Aramco, bigger than the whole market cap of the United Kingdom. So, you know, that really does put things in perspective, right? When we talk about how these big cap stocks have really dominated the market action thus far this year.
Must have been our resident Brit that put that in perspective for us with the UK market cap.
Yeah, throwing that in there, maybe.
Well, yeah, possibly. But I think the remarkable thing here, too, is we remember Saudi Aramco's IPO. They were a $2 trillion company at the time they were going public, which really speaks to how Apple has been able to grow out their business, too, to not only meet, but then surpass a company that already had that valuation for an extended period of time, even prior to it making its public debut as well.
Yeah.
All right, let's talk Intel here on the day. We'll stay in the technology sector. Shares of Intel gaining this morning on reports that the chip maker could be an anchor investor in British-based ARM Holdings. The semiconductor and software design company is expected to IPO in the U.S. later on this year after snubbing the London Stock Exchange. Now, Intel's reported investment would give the company access to ARM's chips, much needed leg up to compete with the likes of NVIDIA and Taiwan Semiconductor. NVIDIA had plans to buy ARM after reaching a deal with SoftBank in 2020, but regulators, they squashed that union in early 2022 here.
I mean, Intel basically is trying to prove that it's going to play ball and be a fabricator, not just a designer of chips. That's where it's been trying. So this partnership with ARM that it had before, and now this report that it may be investing in this way, sort of solidifies that or emphasizes that that's what they are trying to do here. So I think that maybe is what's responsible for the stock getting a little bounce on this.
And I mean, it could be a great play, especially considering the weakness that we've seen in the IPO market. There are only a few types of companies that have actually been willing to dip their toe in the water or at least go public. And it's companies like even the raise that we saw from Kava yesterday, companies that are either in the necessities business or those that are in the next wave of technology that investors are kind of capitalizing or at least getting in on the FOMO trade around AI with. And chips are a huge part of that AI trade as well. And so that's where you could potentially see a very welcome reception when this company does make its debut as well.
Yes, we shall see. And speaking of things changing hands, let's talk about Manchester United popping over 30% initially on reports that a Qatari billionaire's acquisition bid had been accepted. But the reports, which seem to originate from Qatari media, come after months of negotiations over a new owner. Shares, though, now paring gains. The Athletic's Joey Durso suggests this was nothing more than a rumor that might have been picked up. Manchester United's current owners, the Glazer family, announced the formal sale process last year, and we have really seen, a lot of fits and starts here. So unclear how legit this latest rumor is. Obviously, as I said, the Athletic said maybe there's not much to it, but it seems like investors just want this to be done already and want the sale to get done to whoever it may be.
Yeah, they do. It's been lingering. It's been an ongoing deal that they're just waiting to finally have the owner announced, it be set, done with. I think the share price reaction just goes to show that everybody is just sitting on the end of their couch right now, waiting for whatever's going to come forward with this deal, and hopefully that the owner is one that will kind of be able to infuse that next wave of capital into the football club as well. So that.
In the meantime, insult to injury? Didn't they lose?
A big player?
No, they lost. Man City beat them. I'm just looking at the latest
scores. Yes.
The latest scores. Anyway.
Nah, that's solid. That rounds it out. Guys, with mortgage rates creeping higher, homeowners are increasingly opting to stay put, leaving less existing homes up for grabs here. That's great news for home builders with demand on the rise. Home builder sentiment hit 50 in May, marking the 5th straight month of gains and the first reading of builder sentiment since July that wasn't negative. So in our latest installment of our week-long series, Real Estate, the New Reality, we're asking, are home builder stocks a good buy, or should investors say goodbye? Joining us now with his picks, we've got John Lavallo, UBS, U.S. Home Builders Building Products Equity Research Analyst. Love your title. Love you. John, thanks for joining the program here today. So,
thanks for having me, guys.
Walk us through some of the home builder stocks that you're keeping an eye on right now, even in this environment.
Yeah, so we like the group at large, to be honest with you. We're really focused more on the entry-level first-time builders, so that would be a D.R. Horton and a Meritage Homes, for instance. But it's a very interesting dynamic that's in the market right now. There's very little existing home supply, as you alluded to, 2.8 months of existing home supply. The supply that's out there is old, and it's generally at price points that the first-time buyer is not interested in. On the flip side of the coin, you have the private builders, which are 60% of the market, many of which are having problems getting land, getting labor, getting materials, and now getting financing. So while demand has certainly slowed, the demand that is out there is all being kind of channeled towards these public home builders that, oh, by the way, can offer financing. So no one's paying 7% out there. They're paying 6%. They're paying 5.5%. So it's a really, really interesting opportunity for market share gains.
At the same time, John, aren't the publicly traded home builders still grappling with supply issues, labor issues, that part of the challenge?
100%. I mean, supply chains are still not back to where they need to be. Build cycles are elongated. Materials, depending on the day, the materials are still hard to come by. Right now, it's transformers. So getting the communities actually electrified is the biggest hiccup. And, I would even say go as far back as, the actual development and entitlement of the land, getting land actually zoned and ready to be built upon, and then ultimately, built upon is taking a lot longer than it has historically. So the whole process is, delayed relative to how it's been in the past.
And so what should buyers expect with that still lingering in the home purchasing process now?
I think the market is still pretty competitive. And so, on the existing home side, as I mentioned, there's just not much out there. So I think buyers that are looking for a home at this point are probably more inclined today than at any point in history to have to focus on a new home. And so, that is what this dynamic is sort of what's keeping home prices from falling. They've actually been very, very resilient, which is a good thing for the overall home market and for the home builders in general. But it's a competitive market for sure.
One of the things that we've talked about regularly when it comes to new home construction is finding places to put them, right? Buying the land, getting the zoning, et cetera, et cetera. And I know that this is highly regional, so it's difficult to make sort of a national generalization. But what kinds of trends are we seeing there, especially given the tight supply? Have we seen sort of a loosening of the willingness to get these things built?
It's a great question. I mean, I think in certain markets, as you mentioned, it is a very market by market dynamic. In certain markets, it is easier. Texas and the markets throughout Texas is a great example of, a kind of a builder friendly environment. The same would be in Florida. And I think this is really important because if you think about a couple things, one, kind of the flow of migration trends into kind of the Sunbelt states. That's where all the job growth is. That's where a lot of people are moving, for the weather and for just kind of a different type of lifestyle, not to mention jobs. The first-time buyer that's going into these markets is generally a little bit more willing to make concessions, meaning that they'll move a little further away from the city, right? They'll buy a smaller footprint. These are the things that sort of help the math pencil in a market that is really a challenge from an affordability standpoint. So I think to your point, you're seeing, at least for the public home builders that we cover, you're seeing very little sort of infill building. You're seeing them move out sort of to on the periphery of markets where there's open space and where they can develop these very large communities. And by the way, help the math pencil for the home buyer.
Yeah, no, that's spot on. So where does this sit right now for the newest kind of cohort of home buyers and entrance into the home markets? I'm speaking about millennials, especially as there are now more millennial home owners than there are those who don't own homes, and I'm now in the minority, I suppose, as that's kind of flipped on its head here. So are we going to expect to see a steady movement, a steady trickle of more millennial homeowners into homes if we continue to see some moderation perhaps on price, even though we're still looking at a broader rate environment where that means that the home is going to be more expensive over time?
Yeah, we think so, right? I think to your point, this millennial buyer is reaching sort of prime home buying age, so call it 30 to 35 years old, and having life events. They're getting married, they're having children, things that by definition necessitate more space. And, we've certainly gone through a very bumpy market over the past 15 years or so, but the allure of home ownership has really not lost its luster. And it is still sort of that American dream. And people want to move into homes, and they're going to do what they can to make that happen. We're also in the midst of probably the largest generational wealth transfer in the history of the country, which is helping some of these first-time buyers make down payments, make the affordability equation a little bit more palatable. So yes, the simple answer is that millennials and future generations are still going to want to buy homes, and they're out there right now looking pretty intently to do so.
John, let's bring it back to investors. What, do you like all the home builders? Are there ones that you think are going to do particularly well in this environment?
So we think the group at large is well positioned, the public home builders that we cover, for the market share dynamics that I had mentioned. But to your question, D.R. Horton and Meritage Homes are kind of entry-level, first-time focused home builders. We think that that's sort of where the juice in the market really still is. And that goes back to the need-based buyer element that we just spoke to, and the fact that there are a lot of folks that are reaching this prime home buying age. So those are the two that we would kind of point to as being, in our view at least, best positioned from a price point standpoint. And then in terms of geographic footprint, most of the builders, as we previously discussed, are in those kind of sunshine states. So from a footprint standpoint, also very well positioned.
All right. Our thanks to John Lovallo, who is the UBS U.S. Home Builders Building Products Equity Research Analyst. John, great to speak with you today.
Thanks for having me.
Absolutely. Coming up, everyone, former President Trump is making his appearance in a Miami court this morning. What we can expect next. Apple stock moving a little lower today after a downgrade from UBS. The firm cutting the tech giant down to neutral from a buy on soft iPhone sales and services growth. Yahoo Finance's Jared Blickery coming to us now from the New York Stock Exchange with more on this. Hey, Jared.
Hey there. Well, it's Apple, and we've seen this incredible run. Also happens to be options expiration week, and I'm going to tie all this together. A lot of times, if you have a stock that's come a long ways off of its lows the way Apple has, and you want to protect yourself, and you're not necessarily heck bent on keeping that stock forever, you can sell calls against it. So in Apple, you could sell the 185 calls, the 190 calls. So if price goes up, you got to give it back. You got to give it to somebody else. But in the meantime, if it doesn't, if it just comes back and pauses or goes down a bit, well, then you get paid and you get to keep the options premium that you sold. So just throwing that out there. But you look, Apple's basically been in a trading range for the last 2 years. It peaked around January of 2022. It had a dip into mid-year, retested the low in January of this year and exceeded it a little bit. And why do I say that? Because Apple does have a history of faking investors out, and now it's going to the upside and it's exceeded its prior high. So is this a little bit of a fake out? Could be. Might be time for Apple to take a pause, especially with all the options activity this week. But going forward, it's just an incredible story, and it's hard to argue with the juggernaut.
Yeah, and also let's talk about currencies for a sec. Related to what's going on with Japanese stocks. Foreign investors have been piling into Japanese stocks over the last few months. We've been talking about it. It's taken them to new highs. So, Jared, what are we seeing today?
Well, we're seeing a Japanese central bank that has been under pressure just because their policy of yield curve control has been a little bit, how should I say, a little bit too much for the markets. We've seen the yen devalue relative to the US dollar and most global currencies quite a bit. So this does present, it's not an imminent conflict or problem for the Bank of Japan, but they have big decisions to make around their meeting this week. I'm not expecting any big fireworks here. By the way, I would just mention in terms of central banks, we did get a rate cut by China, and this is coming as some other central banks around the world, those in countries with commodities like Canada, like Australia, they're raising their rates. So we have a situation that is probably on pause. Chinese are cutting. Other commodity currency countries, they are raising rates. All of this together, everybody's trying to figure out what the equilibrium is. And the fact is, nobody knows because it takes time for all of these policy effects, for those lags to catch up with reality. So I do think it's prudent that the Fed is probably going to pause here and reassess. But with respect to the Bank of Japan decision, they're under the gun here. They cannot lose control of the market for Japanese government bonds, which they pretty much own right now. So they got to walk a tightrope that's even finer than Jerome Powell.
Yeah, that's saying something. Thanks so much, Jared. Appreciate it. Well, speaking of tightrope walking, the city of Miami is preparing for possible chaos outside of the courthouse where former President Donald Trump is set to be arraigned this afternoon. Police officials and Mayor Francis Suarez saying that they are prepared for any protests or crowds that may gather as Trump faces 37 federal charges. Joining us now with what we can expect, how we should be thinking about this case and trial overall is Richard Painter, former chief White House ethics lawyer and professor of corporate law at the University of Minnesota Law School. Richard, thank you for being here. So I know that you have a view on the judge who is set to oversee the case, but just to take a step back from that and set a scene here for what we can expect today, what can we expect from the arraignment? What happens next? And how should we be viewing how the former president is sure to frame this whole situation?
Well, this should be a standard arraignment where the defendant appears before the judge, pleads guilty or not guilty, or before a magistrate, and is processed very quickly. There's nothing much the substantive that's going to happen today. I believe there should be a different judge, and this Judge Cannon, made some decisions in connection with the investigation, trying to stall the investigation that were overturned by the Court of Appeals. And I think it'd be much better just to start fresh with a different judge. This is about protecting our national security and classified information. I gave the lectures to the Bush White House on protection of classified information in 2005. We take this very seriously in the United States government. This is not a partisan issue. And I've called for a full investigation of what happened with the Biden documents. particularly the documents held at the University of Pennsylvania, Penn Biden Center, investigation of the Chinese fundraising by the University of Pennsylvania. So this is not a partisan issue. Whenever you have classified documents that have been placed in an unsafe environment, it's critically important to immediately have an investigation and for everyone to immediately cooperate with the investigation. And the difference here is that Donald Trump refused to cooperate. He obstructed the investigation. And that is a very, very serious offense if that can be proven by the prosecutor. These investigations aren't just about fault finding. They're about finding who saw the documents, who may have had access, what national secrets may have been compromised. And full cooperation with these investigations by the FBI, by our national security officials is critically important. That's what I told the Bush White House in 2005. I believe the Biden administration is doing that and encouraging the University of Pennsylvania to cooperate with that investigation. Donald Trump didn't do that, and that's why he's in the courthouse today.
Yeah, the evidence laid out in those charges do seem relatively damning on that point. I do want to return to Judge Eileen Cannon for just a moment, because as you laid out in a recent op-ed, you do think she should recuse herself, as you just mentioned. Bottom line, do you think she is not impartial in this case? And do you think there actually is a chance she'll recuse herself?
Well, the standard under the federal statute, 28 United States Code 455, is whether a reasonable person could question the impartiality of the judge, not whether the judge is or is not impartial. This is a question of what appearances there are out there. And it's critically important in criminal cases for judges to recuse when a reasonable person could believe there is bias. If a judge does not recuse and there's a perception of bias against the defendant will likely win a verdict on appeal. And the same thing here. This is a judge who has made several decisions that were overturned by the Court of Appeals, favoring Donald Trump, blocking the federal investigation, denying the United States government custody of its own classified documents. And I believe that it's going to be best for everyone if we start with a new judge.
If she doesn't recuse herself, do prosecutors have any recourse?
Prosecutors could move to recuse, ask the district court to recuse, the chief judge to ask her to recuse, go to the Court of Appeals in some circumstances. The best thing is for the Judge Cannon, to voluntarily recuse. She has plenty of other cases to hear, and allow another judge to hear this case. So there will be no question about the impartiality of the judge. And if there's another judge who has strongly criticized Donald Trump and shows bias, appears to show bias against him, that judge also should not hear this case. Whenever you have these problems, particularly in a criminal case, there can be a chance of a reversal of a verdict on appeal, and that's not where we want to go.
Realistically, timeline-wise, how long do you think this proceeding could actually take? Could we be talking about a proceeding that goes to or even through the 2024 general election?
The defendant has a right to a speedy trial. Donald Trump has a right to a speedy trial sometime, probably. There's no clear measure of that. But if he wanted a trial within the next 6 months to 1 year, he could get that. Now, whether he wants that or not is another question. Now, the defendant does not have the right to indefinitely delay a trial. It's doubtful that Donald Trump would be able to delay this trial till after the November 2024 election. But if he sought some delay, the trial probably would be scheduled sometime in the summer of 2024. But hopefully this trial will take place earlier so the matter can be resolved.
We asked a guest, even in our preparation for a segment yesterday, whether or not a person who was convicted of the charges that are put forward in this indictment or the allegations that are put forward, whether they could actually, if proven guilty, still be elected president of the United States.
Well, the statute says that some of these offenses concerning classified information, a violation of the statute, precludes one from assuming public office in the United States. That's what the statute says. There are serious questions about whether that's constitutional with respect to elected office. I will emphasize that still the most serious charge that could be brought against Donald Trump has not yet been brought, and that is for sedition. in connection with the January 6, 2021 insurrection, the attempt to overthrow the election. If Donald Trump were to be found guilty of sedition, he would clearly be disqualified from public office under the 14th Amendment, Section 3, which disqualifies from public office anyone who has sworn an oath of loyalty to the United States and then given aid or comfort to any attempt to overthrow the United States government, an insurrection of the sort we saw on January 6th of 2021. So those charges have not yet been brought. They might be brought by the special counsel. And those are the charges that clearly constitutionally would disqualify anyone from assuming any public office in the future.
What do you think is the likelihood that those charges will be brought, and what would the chances of success be in that case?
I've urged that the Department of Justice consider such charges very seriously. This was an attempt to overthrow the government. This happens in many countries where an elected president decides to stay in power despite an electoral defeat or the expiration of the president's term, and then seeks to use the justice ministry and or the military and or a mob gathered outside the Capitol building to seize power. And unfortunately, this has happened where elected leaders, prime ministers, chancellors have perpetuated themselves in power through a so-called self-coup, autogolpe, as they sometimes refer to as in Latin America. It happened in Germany in the spring of 1933 when Chancellor Hitler took control of the government. Autogolpe, self-coup, this is extremely dangerous in a representative democracy. That's what happened on January 6th of 2021, and Donald Trump has his fingerprints all over it.
Richard Painter, former chief White House ethics lawyer and professor of corporate law at the University of Minnesota Law School. Thanks so much for taking the time here with us today and help us piece together some of the parts of this indictment as well as others that may come forward in the future.
Thank you for having me.
Certainly. Coming up, May's headline inflation prints ticked down on the month. So what does this mean for the state of the economy? We'll break down those numbers next.
Just after 10 a.m. in New York City, this is Yahoo Finance Live. I'm Julie Hyman along with Brad Smith, and we are 30 minutes into the trading day. Let's take a look at what has moved since the open of trading.
Yeah.
Was that supposed to be me or was supposed to be you? I don't know.
Trade places.
We're here together. Okay, let's talk about shares of Apple. The tech giant reaching a record high at market close on Monday. Market cap hitting $2.89 trillion today. The stock is down about 0.5%. UBS downgraded Apple shares this morning from buy to neutral. And the analysts there citing the economy's murky picture, saying it will affect Apple's iPhone sales, particularly in so-called developed markets like the U.S., even as it continues to see more growth in emerging markets.
Also keeping tabs on shares of Urban Outfitters. They're trading higher Tuesday. The retailer received an upgrade on the stock from Morgan Stanley, the firm changing its rating from equal weight to overweight this morning. Morgan Stanley noted that Urban Outfitters has positioned itself well into 2023 and de-risked its low valuation. Shares moving higher on that by about 3.9%.
And guess what? We got a regional bank to talk about today. Zions Bancorp shares slumping after the company said its second quarter net interest margin is trending toward 2.85%. That is apparently weaker than what analysts had been predicting. A number of them coming out and commenting on the stock today. Keith Brewett-Woods, which really focuses on a lot of these bank stocks, says, quote, the outlook for deposits remains the most important near-term fundamental consideration for both the group as a whole and Zions stock in particular, even as he says that net interest margin was indeed below his estimate.
Well, May's headline inflation print ticked down on the month, but that all-important core figure still sticky. Let's bring in Yahoo Finance's Jen Schonberger to take a closer look here at these numbers and break down what they mean for the Federal Reserve's interest rate decision on Wednesday. Jennifer?
Good morning, Brad. That's right. The consumer price index on a core basis coming in just a hair above expectations, but overall showing that inflation is on a slow downward trajectory, all but sealing in the case for the Federal Reserve to pause its interest rate hikes at tomorrow's meeting. Now, let me run you through these numbers. I want to focus on core CPI because that's really what the Fed is focused on. That strips out those volatile food and energy prices. That clocked in at 5.3% for May. That compares with 5.2 expected. Now, if we take a look at how this number fits into the trend overall for this year, May, again, 5.3%. Take a look at that compared with the month prior in April, and as far going back to the beginning of this year as January, it's just slightly down from 5.5 to 5.6%. So again, just showing a very slightly edged downward move there. Now, the other key metric in this report to look at is the services excluding housing. This is a key metric that the Fed has been focused on. It has been very sticky this year, but we are seeing progress this month. It clocked in at 4.2% in May. That's down from 5.2% in April, and down from as high as 6-7% earlier this year. So that is some major progress there and something to cheer about for the Fed. Investors certainly looking at this report and thinking that it bodes for a pause for the Fed tomorrow. Take a look at those Fed funds futures, pricing in about a 94% chance that the Fed will not raise rates tomorrow. But even as this trend is signaling slower inflation coming down, it is still elevated on a core basis. And for that reason, we will likely see Fed Chair Powell and company signal that they are not finished raising rates. Guys?
Yes, so a skip instead of a pause, I guess. Thanks, Jen.
Instead of a pause, yes.
Jennifer Schonberger, thank you. So as we've said, all eyes on that Federal Reserve decision tomorrow and the rhetoric. Economists are expecting the Fed will stop or at least pause raising interest rates for the first time in 18 months. Let's bring in Yelena Malayev, who is KPMG economist, and Kyle Campbell, American banker reporter, to weigh in. Yelena, I want to start with you. The CPI report this morning doesn't seem to have changed anything materially, although one of the things that the Fed reportedly has been watching, those shelter costs, they did not really abate.
That's right. And that is why we do expect that while the pause or the skip that will occur at tomorrow's meeting is very likely that the rate hike cycle is not over. This is simply because the pause and the skip is simply because the Fed and Powell just want to see what the impacts of this tightening of monetary policy is going to look like in the overall economy, but it's going to take some time for that to really show up in inflation and in those really sticky measures of inflation, especially in that core services, that ex-housing component. And so this is why we're paying very close attention to these numbers, because this rate hiking cycle and this fight against inflation, it's a marathon, not a sprint. And this last mile, getting it from that 4% to about that 2% target is the hardest part.
What we've heard, Kyle, from so many of the banks over the course of this earnings season is that the consumer is financially healthy, in good condition, and their spending is resilient. If you look at these continued figures, how would you classify the consumer? How might the Fed even classify the consumer?
Yeah, I mean, I think the Fed is going to see the consumer as resilient. They're going to say the economy is strong. They're probably going to say that the banking system is strong and resilient as well because of that. But I think what's really critical, and probably why a lot of banks are going to be enjoying this slight reprieve, this skip, if you will, is that it does give them a chance to really get their house in order and deal with a lot of the issues that are still going on. I mean, you saw the figures with Zions Bank. That net interest margin is under a lot of pressure right now because you do have depositors. Maybe they're not fearful like they were in March, but they're really looking around and saying, what are my other options? Like for well over a decade, you could just keep cash in the bank and it was like cash in your wallet. It wasn't really going to change value too much. You weren't going to get paid much for it. But now, even if you're not worried about a bank failing, you're going to be saying, hey, and this is you as an individual, but also you as a corporate treasurer are going to be saying, hey, where can I put this money and how can I put it to work in a better way? So that's a lot for banks to deal with. And I think, while they make sense of what this means in the real economy, they're also going to be saying, what does this make sense? How does this impact us? How are we going to adjust our loan portfolio and sort of readjust our business to try to mitigate that pressure on the net interest margin?
And Yelena, when we talk about whether rates are going to continue to move higher, what that's going to do for the banks and for all of us, right, who are subject to interest rates, there is sort of this increasing discussion recently that we've been having here on the show about what the current biggest driver of inflation is, and sort of this narrative emerging of excuseflation or whatever you want to call it, where it's companies who are sort of taking this as far as it can go with pricing power. When are we going to see that pushback? And is it even something that the Fed can affect?
It is not something that the Fed can affect. And this is one of the reasons why we really are focusing more on that core inflation, especially core ex-housing, because when we looked at margins, especially for energy companies, those have been the strongest over this last period of inflation. And the real concern that we have as economists is that right now we're in still a very favorable year-on-year comparison stage, meaning last year energy prices actually peaked in June. So even next month's inflation data is going to look like things have been cooling overall, simply because of just that favorable comparison. And then we're also really nervous and worried about the housing market, and that home prices are starting to turn around again and go up and actually accelerate potentially in some markets in the country, all of which feeds into this inflation number. All of these are components of inflation that have been disinflationary over the last few months, that have been helping us come down from that really high inflation peak earlier last year. And those are potentially going to reverse course and start to reaccelerate, while that sticky component, that core services ex-housing, does not budge downwards. And that means that the Fed has even more work cut out for them and even more potential rate hikes past July's meeting.
Okay, so that starts to get to the question that I was about to follow up with there, Yelena, because what does this signal for the activity that the Fed has to take? What arrow do they have in their figurative quiver, if you will, to deploy up against even the wages that have continued to be essentially, in some cases, passed through to consumers in the prices that they're paying for goods and services?
Right. Monetary policy is a blunt tool, so it's not very necessarily the best tool to use at a time where a lot of these inflationary pressures are actually coming from the supply side of the equation. The Federal Reserve can hammer demand. They can bring down demand for goods, for automobiles, even for housing through, very high now mortgage rates, but they can't fix supply. They can't increase the labor supply, especially in the areas of the economy that are still struggling to find workers, hospitality and healthcare, just to name a few, construction as well. And so they have this very blunt tool that they're trying to use to bring down demand to meet supply in a very supply constrained world. But it's up to other areas in the economy, specifically banks that are issuing credit to really let that credit tightening flow through to the end consumer, so that we do finally have that pullback in demand, not to deep freeze the economy, but just to cool it down a little bit so that prices can come back down to that 2% target.
Well, Kyle, what do we know about what's happening on that front? Sort of where are we in that credit tightening cycle? What are we hearing from the banks right now?
Yeah, it's a great question. There's definitely a tightening of credit, and that's by design, of course. That's what the Fed has been trying to do by raising rates. And we aren't really sure exactly where we are in that life cycle. It's going to sort of, you'll feel it when it hits sort of type environment. So I think we're going to see a lot of banks pulling back if they haven't already. And again, like I said, trying to think about how they want to adjust their loan portfolios, right? Because when you have an outflow of deposits, or even if you are keeping your same level of deposits, you're having to pay more for them. So you have sort of two options as a bank. You can either stay put, not grow, not take on more risk, or you can, try to, I guess, take the pain now, maybe raise more capital, and then start to grow the book and maybe sort of capture some of these higher rates in that loan portfolio. So yeah, it still is we're kind of moving in the dark a little bit as to where we actually are, but we're seeing signs of tightness early signs of tightness in the credit cycle, and we'll sort of see how that plays out moving forward.
And just lastly here, we'd love to get both of your reactions to this, both Yelena and Kyle here, but Kyle, as we think about the financial conditions and who this is impacting in this near term for small businesses, for some of the investors. We had the Shark Tank, Mr. Wonderful himself, saying that for some of the small businesses he invests in, that it's essentially dried up. There is no lending or funding that they can access into capital from banks with. So what would you define, how would you define that access to capital for small businesses right now? Yeah, I mean, it's going to be tough, because that's going to be one of the areas where, again, if you're a bank, you don't want to be taking a lot of risk right now. Sometimes smaller businesses are more risky. You want to and this is sort of where you have this sort of bifurcation of the banking system, right? And if you're a smaller community bank, you might be more comfortable to lend to a small business in this environment, because the fundamentals, the people better. Larger banks are going to, they have their business lines, and they're going to sort of stick with those bigger businesses. The middle is where we saw the pressure earlier this year, and that's where we're going to continue to see pressure going forward. Yelena, wanted to give you a chance to respond to that too.
Thank you. Small businesses have been essentially the engine of growth in our economy, especially since the COVID recovery. We're still seeing very high number of applications to form a business, and these are the types of businesses that are likely to hire, as well as really elevated job openings numbers are still in the economy, especially from those businesses with 250 workers or fewer. And so this is where actually this will be difficult for those small businesses when it comes to access to credit. But this is actually one of those silver linings where we could find this immaculate disinflation if smaller businesses just come back down to those 2019 levels of hiring and formation, and then are able to no longer need to really increase their wages and prices in order to compete in the market. We could actually have that disinflation and cooling of inflation in the economy without necessarily a recession occurring.
Thanks to you both. Appreciate you being here. Yelena Malayev, who is KPMG economist, and Kyle Campbell, American Banker reporter. Thanks.
Thank you.
Thank you.
Well, coming up, the AI frenzy is pushing cloud demand higher. We'll break down Oracle earnings with an analyst from Mizuho next. Well, Oracle shares are climbing higher this morning after its cloud revenue jumped 54% year over year as it expands its AI offerings. The software company also forecast revenue growth of 8 to 10% for the first quarter. The shares trading at a record today. Siddhi Panigrahi is Mizuho Managing Director and joins us now. Siddhi, thanks for being here. So these Oracle numbers on the face of it look pretty impressive here. How do we suss out how much of the demand currently and going forward is AI versus the sort of existing lines of business?
Yes, great to be here. Look, this Q4 results, definitely they beat expectation, and this was one of the much awaited quarter because they not only established themselves or proved themselves to be one of the fourth largest hyperscaler or cloud service provider, but also you see that they're joining this AI trend. That was impressive. Like cloud growth was phenomenal, like 30% in constant currency, organic cloud growth, 33%. And when others are decelerating, their cloud revenue is accelerating, although at a lower base. But what was also interesting to your point on AI, Oracle, they talked about, recently almost like $2 billion plus contract. Where this new AI vendors, emerging AI vendors have contract with to use that capacity. So not only they are becoming a cloud player, we're going to host all this large language model, LLM, to be trained on this. They also talked about partnership. They have NVIDIA partnership. In fact, NVIDIA is one of their customer who uses AI development on Oracle Cloud Infrastructure. And another open AI competitor, Cohere, they announced a partnership and investment with them, and they're going to bring this, AI services for enterprises. So definitely Oracle is not only establishing themselves as a cloud provider and becoming even a AI, but they're joining the AI trend.
Siddhi, I don't know if you're an NBA fan, but it seems like Oracle is like the Nikola Jokic of cloud companies. And I say that because it's not necessarily sexy how they get the job done, but they figure out a way to use the tools around them that they've been able to essentially kind of lean into for years in some of the services and subscription side of the business, while also trying to get closer to some of the next wave of technology. And so all of that considered, when you think about if Oracle is able to perhaps supersede or at least get past some of the other headwinds that this broader industry is facing, especially on seat count compression, especially on deal scrutiny. Is this a company that has kind of been able to go above and beyond some of those other concerns that have plagued other companies within this cloud industry?
You know what, that's a great comparison, Nicolas Jokic. But look, I'll say that Oracle, last 10 years from 2012 to 2022, you look at their revenue CAGR was like 1 or 2%, because they were trying to establish themselves. They're losing some of their customer base to this emerging cloud provider. So it took some time, but they had the strategy that they will turn around the company and become an established cloud vendor. And that is what right now resonating right now. There are two parts of their cloud business. One is their Oracle Cloud Infrastructure, which is like Amazon AWS or Microsoft Azure and Google. These are the three established vendors, and they're trying to position themselves. They build all this infrastructure, all these cloud services on that, and now AI is on top of that. So their advantage of this cloud is they have their massive customer base. 400,000 of customer base they have there. They can combine all their contracts. They offer, this is one of the company provide end-to-end technology platform for an enterprises. They have application, they have database, they have now infrastructure as well. So all this combined, now they can sell even the Oracle Cloud Infrastructure to their customer base. And that is one part of the story. And the other part of the cloud story is the SaaS business, application business. And remember, Oracle was one of the established cloud application right now. We have seen CRM is already, Salesforce dominating in the CRM space. HCM is Workday, but Oracle coming in as an established ERP vendor. And next leg of growth in SaaS cloud you'll see is the ERP. And so Oracle is kind of trying to benefit from both trends. And yes, you'll see that now this momentum will continue from here. And one thing I want to highlight also that they did give their fiscal 26 guidance of reaching $65 billion revenue and 45% operating margin. Look, I don't think investors at this point believe that they underestimate Oracle potential, but after this fiscal Q4 results, I'm pretty sure people will believe that, and you can see upside to the estimate.
Citi, what I can't wrap my head around is this year was supposed to be terrible for a lot of these types of companies, right? We keep hearing companies that are in theory or their clients, they're cutting back, they're cutting workers, they're cutting costs. How do companies like Oracle still manage to do we get the environment wrong, or is it just that companies are not cutting these kinds of services?
Yeah, that's a great point. Look, Oracle strategy is the way they differentiate it is they will give you high performing environment or product or cloud environment at a lower price. That is an advantage they have. This is helping them, and that is definitely resonating. And this results has clearly signaled that that strategy is working. Price performance, that is the key here. And that's why a lot of CIOs are under pressure, like you said. They have to move to cloud. There's a cost saving there. You don't have to maintain your infrastructure, and that is what Oracle's seeing right now. A lot of their existing customer moving their infrastructure, let's say legacy application on your data center, you can move to Oracle Cloud infrastructure, and they have a lift and shift strategy. When you consume $1 of cloud, they are giving you 25 cents to 33 cents of maintenance credit. So this is actually, two way you can benefit from that. You are going to have some cost saving because you don't have to have your own people maintaining all this environment at your own data center. And then also you get some maintenance credit. So definitely in this kind of environment, like you said, that's a good point. This is helping even your customer. So that's I think one of the factor helping Oracle too.
Citi, really solid analysis. Citi Panagrahi, who is the Mizuho Managing Director, joining us to talk all things Oracle. Thanks so much.
Good to be here. Thanks.
Coming up, everyone, wondering what's going to happen to all that empty office space? Well, Danny Romero is on site in New York with the look at the future of real estate in a post-pandemic world. That's next. As part of our week-long series, Real Estate, the New Reality, we're taking a look at the reinvention of office space in the wake of the pandemic, with more employees working either remotely or on a hybrid schedule. Pre-COVID office space requirements are becoming a thing of the past. Office occupancy hovers just over 47% across the U.S. With so much unused office real estate, there's a push to rethink how those empty floors could be put to use. Here in New York City, one major project is in the works in Lower Manhattan, turning a former office into apartments. Yahoo Finance's Danny Romero joins us live from 160 Water Street. Danny, take it away.
Brad, you're taking a look at the view of the future of housing in New York City. There's been a big push statewide, not only here in New York City, but across the country about converting office space into residential housing. And to get a closer look at what this building has in store, I'm joined with Joey Kaleli, Managing Director of Van Barton. Thank you so much for joining us. And your team has been really hard at work. And so what are you looking forward to with this conversion project?
The most is just creating a vibrant environment for new residents, new housing supply for the city, and really reshaping the face of Water Street.
For this specific project in the financial district, what has been the biggest challenge?
Just taking an office building, creating with all the complexities that go into that, and creating residences that people will love and are marketable, and that you come into and you don't realize that you're actually walking into a former office building.
Conversions can also become complex at times. So what has been, would you say, the misconceptions when it comes to converting office space to residential housing?
Yeah, I think a lot of people think that it's too complex, too costly, but it really is just creating a new building from an office building and making it so that people don't realize they're coming into an office building. Like I just mentioned, how you want to come into a space and feel like you're home and not that you're coming through a former office building. Those are the biggest complexities.
And so New York State leaders, the lawmakers, they're falling pretty short on these proposed tax benefits, those breaks.
Yep.
What is your response to that?
I think, simply put, the inaction of lawmakers is causing and exacerbating the issue with the rising rents. And so the inability to at least look at rezoning and enact something that would help more office buildings to be able to be converted, or industrial sites, or even changing the date, where south of Murray Street in Lower Manhattan, 1977, in certain zoning districts you can convert. But in Midtown, that's 1961. So a couple of those simple matters, they could change and really help put more units on the market, which will help that supply. It won't solve the whole issue, but it'll help.
And are financial incentives the way to kickstart a project like this?
I think it's a combination, the financial, certainly, but just at least looking at the date and changing the date of when an office building could be converted will go a lot further.
And for someone who's interested in this space and renting out an apartment or leasing out, how soon can someone jump on that?
Yeah, the team is hard at work, as you can see, and we're finishing up so that we have our first residents move in later in September of this year and early October.
So you heard that, Brad, right? Later this year, this unit will be available. Yeah. Hopefully, this 2-bedroom, 2-bath unit that we're standing in. But again, thank you so much for joining us. This is Joey Kaleli, Managing Director of Van Barton. I'm going to throw it back to you guys.
How much? How much can people rent it for?
How much? Oh, rate. What was the rate?
So our studios will start from, generally speaking, $3,500 or $3,750 on up to 2 bedrooms like this. They could go anywhere from $6,500 to $7,500.
All right, $6,500 for this 2-bedroom. Julie?
Not exactly affordable housing, but there is definitely a shortage, I guess, in New York City. So thanks so much, Danny. Appreciate it. And thanks to Joey Kaleli, Managing Director at Van Barton Group. Really interesting, these conversions that are going on. Appreciate it, guys. Coming up, more companies are looking to transition into a green economy, but demand for talent is outstripping supply. We'll tell you about LinkedIn's annual Green Skills Report on the other side of the break. The global shift toward a green economy is gaining momentum, and it could have a significant impact on the demand for skills in the labor market. LinkedIn has released its annual Global Green Skills Report that provides insight on the latest work trends and environmental sustainability. More companies are looking for green talent. Within the last year, 22.4% of job postings required at least one green skill. And while there's a strong demand to hire workers with some sort of environmental knowledge, people are not developing these skills at a fast enough rate to meet global climate targets. For more, we're joined by Sue Duke, Vice President of Global Public Policy and Economic Graph at LinkedIn. Sue, first of all, what is a green skill? Tell us what that entails.
A green skill is a skill that directly combats the effects of climate change. So it is a skill that is either taking out pollution or preserving natural resources. Think of skills like water preservation, sustainability manager, or energy efficiency. They are all the kind of skills that are driving that impact towards preserving natural resources and combating the effects of climate change out there.
And so how many more of these positions are we expecting to come about, to come online within so many different employment situations over the next couple of years?
This trend is very clear. It is growing all the time, and we expect it to increase in the months and years ahead. When we look back over the past 5 years, we can see clearly that jobs requiring at least one green skill have grown 9% every year. And the biggest jump that we've seen so far was last year. Last year, we saw over 20% increase in jobs requiring green skills. And let's not forget that that was a year when we typically saw hiring and activity slow down in the wider economy, not when it came to demand for green skills. There we saw that trend speeding up and that demand increasing all the time. We expect the same to continue as we move forward.
It's so interesting, Sue, because we talk so much lately about AI, right? And that there's going to be this big need for AI workers. We talk much less about this area. So it does seem that there is a skills gap as well. What does that stem from? Is it that are people not studying this stuff? Is it just that there's not a high enough rate of people who are studying it and coming out of school with it or reskilling to focus on these areas? What's the cause of it?
This is a very significant shift for the economy. We are talking about transforming the entire economy and putting it on a more sustainable footing if we're going to reach those 2030 and on out to those 2050 targets. And that's not going to happen overnight. First off, one of the drivers is the demand is just so strong for these green skills. We currently have only 1 in 8 workers with green skills, and their ability to meet that demand is just not there. That demand is growing all the time. And it's important to remember that that demand, of course, that's coming from the green sector, but we also see it coming from across all industries. So some of the fastest greening roles out there are jobs you just wouldn't think of as green jobs: fleet managers, compliance managers, health workers, data scientists. They are all roles that are going green every day, and it is very, very challenging for workers to keep pace with that demand. We have got to start investing in green skills and upskilling workers so that they're going to be able to take advantage of the opportunity that this transition presents.
Does having green skills mean that someone can get paid more?
It means that your future employability looks really, really positive. So just in the past year, we saw that demand for green skills grow 15%. We saw demand slow and slacken elsewhere. We also see that workers with green skills are 30% more likely to get hired than workers who don't. So investing in green skills, investing in this area is not only going to be good for you, it's going to be good for the planet too.
What's interesting here is I believe your survey found that in all of the countries you looked at, this was a common theme, that there was an increase in demand for these types of skills. Are there, though, differences, right? Are there things that workers in the U.S. need to know versus workers in, say, Ireland need to know about the differences in demand?
We do see variation. Of course, we see this demand coming in all sectors across all countries, but we also see variation in the supply of workers. Auto is a great example. Currently, the supply of auto workers with green skills in the US is about half the rate that we see in a country like the UK. The good news is that that supply is growing all of the time. So in the past 6 years, we have seen auto workers who gained green skills increase 6-fold. And what's very clear is that they're responding to a very, very strong and growing demand out there. Recruitment for auto workers with green skills shot up 300% in that period. So we know that that demand is going to keep growing. The best thing that workers can do is put themselves in a spot where they can avail of these opportunities. And the single best way to do that is acquire and start applying green skills.
We continue to hear more about how there is going to be artificial intelligence that's weaved into the fabric of an organization's operations, and that it could replace some roles, but it could increase productivity at the same time. And you're going to have some roles that work in tandem with artificial intelligence or augmented intelligence, however you want to classify it. Is that a green skill? Just the ability to work with perhaps something that is increasing productivity with a company?
any skill that can leverage a technology that allows us to take pollution out and preserve natural resources is a green skill. And we typically see that workers with a background in science, technology, and engineering are breaking into those green skills at a faster rate than those who don't. So we are increasingly going to see application of technology helping us meet our climate targets. And our job is to get workers those skills in tech and in green to make sure that technology and workers can do just that.
Really great to speak with you today. Sue Duke, VP of Global Public Policy and Economic Graph at LinkedIn. Thanks so much.
Pleasure. Thank you for having me on.
Absolutely. Coming up, everyone, the AI, artificial intelligence battle is heating up. What analysts are expecting from AMD and what it means for NVIDIA. The race to capitalize on the AI hype heating up. AMD unveiling details surrounding its new AI chip, which analysts believe and expect will be direct competition with NVIDIA here. I'm reading through some of the release that they've put out and some of the early reviews that have come forward. It seems like for some of the chips, it's actually going to go towards enterprise customers, enterprise laptops and PCs there, and we'll see exactly what that means in terms of the demand that they're going to see, given that the PC market has been weak to this point. So we could be looking at a multi-year type of strategy. But some of the advancements that were noted within here is how this will increase the ability for, even the framing of your video camera call or your teleconference call, or video conference call rather, that's what I meant to say, how that will improve the the framing there, how it will improve the battery life if you're having an extended kind of period of these calls, 2 hours or more. They tested it on apparently for some of the Microsoft Teams calls out there too. So apparently as this starts to get infused within the production, this can have some of the artificial intelligence mechanisms baked in to just improve the quality of your video conference call, the quality of how long your battery is lasting as well with the devices as well.
Okay.
That's what I understand so far.
I understand nothing except what Dan Halley tells me, who covers this stuff much more deeply than I do. And his impression is that this doesn't necessarily seem to be the NVIDIA killer or even the NVIDIA rival that perhaps some forecasts were looking for from AMD. It's sort of a souped up version and more accelerated version of what AMD was already offering. And that looks like it's reflected in the stock price, which is down a little bit in today's session, whereas we're seeing strength elsewhere in the chipiverse. But it's early in the day. Lisa Su, the CEO, is set to give a keynote speech at this event in San Francisco. So we'll see if there is a bit more to come in a bit more detail. And speaking of Lisa Su, by the way, stay tuned for our 3 to 5 p.m. show today. Our executive editor, Brian Sazi, is going to speak one-on-one with AMD as CEO Lisa Su at 4:20 p.m. You don't want to miss that. And you don't want to miss, look at that, Mark Benioff as well. Sazi also talked to him, and you're going to hear some of that conversation too.
Mark and Lisa coming up. That's the first time I've heard of the chipiverse, by the way. So you put me on today.
All right. Thanks.
Rochelle Akufo has got you for the next hour of trading, everyone. Stay tuned for our very own Brian Sazi's one-on-one interview with Salesforce CEO Mark Benioff. Don't want to miss it. There's a live shot in New York.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Headline inflation is slowing down on the month, but that core figure staying sticky at 0.4%. And that's the number the Fed tends to focus on. We'll get the White House's take on prices ahead of that crucial Fed decision tomorrow. And Apple hit an all-time high yesterday, but a downgrade from UBS weighs on the parade today. Bullish analyst ratings on the tech giant now sit at a 2-year low. How does Wedbush's Dan Ives feel about the iPhone maker? We'll ask him coming up. And our week-long deep dive into real estate continues. This hour will shift our focus to rent. How much are you paying? And after the record surge we saw in major cities this year, is there any relief in sight? We'll have that for you coming up this hour. But first, let's check in on how the major indices are trading an hour and a half into the trading day. Not as much enthusiasm as you would have expected after that data, but the Dow, they're at least up 124 points, about 1/3%. The S&P 500 also seeing gains. They're up 23 points, or about 0.5%. Tech-heavy Nasdaq, they're up about 0.5%, or 70 points so far this morning. Let's also check in on the action that we're seeing with the Treasury market as well. As we can see there, the shorter-term yields there have turned negative, a little bit of a flight to safety in shorter term yields here. But so we're seeing that down about 0.15%, the 10-year up about 0.16%, and the longer term 30-year yields also up about 0.4%. Well, headline inflation rose at its slowest pace in 2 years, up just 4% in May year over year. A good sign for the economy, but is it good enough for the Biden administration? Joining us now is Bharat Ramamurthy, White House National Economic Council Deputy Director. Thank you so much for coming back to us on Yahoo Finance. So I want to get first the White House reaction to this. This is largely in line with economists' expectations.
Well, I think it shows that we continue to make strong and steady progress on inflation. As you noted, we're now at the lowest headline rate that we've had in 2 years. We've now had 11 straight months of declining headline inflation. And it shows that, as the president called for a year ago, that we can make this transition from a period of recovery to a period of steady and stable growth while tackling inflation without giving up all of the gains that we're making in the job market. And I think if you take a step back and look at where the economy is overall, the unemployment rate is near a 50-year low. Inflation has declined for 11 straight months. Wages, including real wages, are going up. So it's a very strong picture overall.
And of course, we have to talk about core CPI. I mean, month over month, if we look at the top contributors there, rental, shelter, and then used cars and trucks, they're still having an outsized impact at the moment. Why aren't we seeing more relief in those areas?
Well, look, there is good sign. I think progress ahead on the core front when it comes to housing. As you know, it takes a little bit of time for the rental data to flow through into CPI. And the data that we're looking at, and I know that many external folks are looking at, would predict that the housing component of CPI will be going down in the months to come, which should provide some relief on the core. Now, look, for folks out there who experience inflation on a day-to-day basis, a lot of that is about energy prices, a lot of that is about food prices. And on both of those, we're seeing steady progress. Of course, gas prices are down well more than $1 since their peak over a year ago.
So for people who are, even though they're seeing some of this inflation cooling, still don't seem to be feeling it necessarily when they're at the stores, how much of that is perhaps about greedflation, some of these prices staying elevated when they don't have to, versus, look, seeing that consumers are still willing to spend this money at the same time?
Well, I think the retail spending, consumer spending figures show that the American consumer feels pretty well about their financial situation. As long as people feel comfortable continuing to spend, that's going to continue to boost economic growth and continue to prompt more business investment. I think if you take a step back and look at where the American consumer is overall, real wages are up, as I said, over the last year, and real wages are up particularly so for people in the bottom half of the income spectrum, folks who really need that extra income after a lot of wage stagnation over the last couple of decades. So we think overall the typical American family, the typical American consumer is doing very well, and that's helping power our economic growth forward.
And in terms of the concerns that the average American has, I mean, there's the poll for June from Reuters and Ipsos. It shows the economy, unemployment and jobs remain their top concerns. Where do you see the economy headed from here then, if these current trends continue?
Well, I think that we're well positioned right now. Obviously, we have an unemployment rate that's well below 4%. It's been under 4% for 16 months now. We have inflation obviously trending in the right direction with a lot of inflation and deflation in the pipeline, according to what we're seeing. And we're continuing to see the fundamentals of economic growth remain in strong position, business investment, consumer spending, and so on. Remember, a lot of what the president passed into law in his first 2 years in office were big incentives for additional investment in the United States. And now we are seeing the private sector respond to that with nearly $500 billion worth of private investment pledged for things like new clean energy production, new semiconductor manufacturing, bringing good jobs, good paying jobs to communities all across the United States. And in many cases, those jobs, that investment is still in the pipeline and will be hitting the economy over the next several months. So overall, we think the economy is in very strong shape and well equipped to weather any other headwinds we have to deal with over the next several months.
Now, that's tough, though, because even though you're seeing these economic improvements, it's not being reflected in President Biden's approval rating. At least according to this survey, 54% of Americans disapprove of how President Biden is handling his job. And that's unchanged from May. And then when you think of the debt default that was narrowly avoided as well, and the budget battles that are still ahead, what are your thoughts on how the American people should really be looking at this when they think of even some of these GOP proposals for what some of the cuts should be in terms of the budget?
Well, I think it's a simple question when it comes to presidents. Are you better off than you were when the president took office? If you look back to the situation we had in January of 2021, we had developed a vaccine but had no plan in place in the previous administration to administer that vaccine. The unemployment rate was well over 6%. I remember on the second day that the president was in office, we got initial unemployment claims showing that 900,000 people had filed for unemployment just that week. And you look at where we are now with the unemployment rate near a 50-year low, with the labor force participation rate at its highest level in 20 years for the working age population, with $500 billion worth of private investment in the pipeline for good paying jobs here in the United States. We feel confident that as the economic data continues to roll in, as the economy continues to make progress over the next several months, that people will look back and realize that the president's economic stewardship through this extremely challenging time has been very good and has put us in a stronger position than basically any other leading economy.
And certainly seeing that inflation number starting to cool hopefully will translate into some relief for everyone. A big thank you there to Bharat Ramamurthy, White House National Economic Council Deputy Director. Thank you so much. Well, while headline inflation came in at around half of last year's peak, core CPI, which the Fed tends to focus on, held steady at 5.3%. And the report comes as the Federal Reserve begins its two-day meeting, where it's expected to pause rate hikes. Joining us now is Adel Zuman, Wall Street Alliance Group partner. So Adel, in your notes, you are leaning towards a pause like many others. Do you think today's inflation data solidifies that now?
Yes, absolutely. And, the great thing is that obviously the Fed's medicine is working right now. They've been very aggressive with raising interest rates from 0 to 5, between 5 and 5.25% within the past 15 months. And what is encouraging is not only is the number is coming down, but also it's not damaging the economy too much. In fact, we are seeing that unemployment is still at a historic low. And consumers, even though they are cutting back on things like home improvements, they're still splurging on areas like traveling and entertainment. So this to us, Rochelle, points to a soft landing, which is the ideal scenario. And that is why you're seeing a favorable reaction from the equity markets.
And so are we talking a pause and a skip? Because in your notes, you said the Fed's job is done. If you could just clarify exactly what that means to you.
So we think that the Federal Reserve does not need to raise interest rates. We are in the camp that this is it. They should pause now, and they will most likely pause. Inflation has come down from 9% and it's at its peak last year to about 4% right now, and we feel that it will further go down from here on its own. The reason being that consumers are going to run through the pandemic excess savings. And they're going to cut back on spending, in our opinion, on the service area, which will probably bring down inflation more. Also, this is as you know, this is a very politically charged environment that we are in. And as we are getting closer to the election season, the Federal Reserve is going to be very aware of not damaging the unemployment rate too much by raising interest rates overly aggressive. And we actually feel that the unemployment rate right now is not reflecting the true picture. It's actually understated because a majority of the layoffs have actually been in the tech space. And a lot of those workers are high earner workers that are not really even claiming unemployment benefits. So that's why we think that the Fed is done. Inflation will start to come down more on its own.
And so then in terms of what comes next for the market, the next catalyst, you say fear of missing out, FOMO, and passing of the baton. What do you mean by that? And what is it that they're going to be afraid of missing out on? Are we talking AI or some other part of the market?
So, Rochelle, the reality is that a lot of people have missed out on the market going up, right? Bears in this market outnumber the bulls. And the reason why investors have missed out is because they are thinking that we are going to get a recession, the market's going to go down. In reality, the market does not work that way. The market is forward-looking. So we feel that the recession was in fact priced into the market in last year's decline. And now the market is, already started to go up. And a lot of these people that are sitting on dry powder are going to come into the market, and they're going to go for the sectors, for the less loved sectors in the market, which have actually been underperforming so far.
I mean, and obviously tech gets all the headlines, but when you talked about some of those underperformers, health, energy, what do you see as some of the better picks that are really sort of flying under the radar at the moment as tech sort of overshadows everything else?
Yeah, so we think, the baton is going to be passed from the tech to some of the less loved sectors in the market, especially some of the cyclical areas of the market with the Fed out of the way, we think could potentially do very well. So one of the sectors that we are looking at is the banking sector, right? So the banks have been hammered over here because of the banking turmoil, but we feel that the turmoil is restricted to the smaller banks. The bigger banks actually, we think, are beneficiaries because as the smaller banks go out of business, where is that business going to go? It's going to go to the larger banks. These larger banks, their balance sheets are much more stronger. They have pristine balance sheets. They've passed the Fed stress test results with flying colors. So I think they're going to be beneficiaries of the banking turmoil, but yet their stocks are down, this year. If you look at Bank of America and JP Morgan combined, they account for about 26% of the banking assets in the United States. We think that with this banking turmoil, that's actually going to increase, and the banking sector, the large banks, we think are going to do better.
So certainly some opportunities to be had, and not everyone just jump into tech. And as you said, they might have already missed the boat on that. A big thank you, Adel Zaman, there, Wall Street Alliance Group Partner. Thank you for joining us this morning.
Thank you.
All right, taking a look at Plug Power, the stock surging today as investors anticipate exciting news at the company's Investor Day on Wednesday. The event will be hosted from the company's Rochester, New York Gigafactory. You see the stock up more than 5% on the day. CEO Andy Marsh teased on Monday that they will be able to show off how much Plug Power has managed to scale up its production. Marsh also reaffirmed the fuel cell company's revenue goal of $1.4 billion in 2023, as well as its long-term target of $20 billion in annual sales by 2030. Now, Plug shares have suffered so far year to date, however, down over 12%. But hopefully for shareholders, tomorrow's event will be a boon for the stock. We'll be keeping an eye on that for you. Right, coming up, we crack down on egg prices and how much they've changed next. Americans are keeping a close eye on the price of their groceries. For the 9th straight month, inflation for food at home, aka groceries, rose a slower rate of 0.1% last month. Brooke De Palma is here with the details. And Brooke, any sort of relief we can get with our food it is always something good.
Any sort of relief at all. I know Americans and shoppers alike are just begging for some relief at the grocery store, and we're here to tell you that it is on the way. Deceleration is really the name of the game here when it comes to the cost of groceries. In the month of May, as you noted, grocery prices increased month over month about 0.1%. Now, year over year, we saw grocery prices increase 5.8%. Now, that was the smallest 12-month change since October of 2021. Now, that's also far lower than the highs that Americans saw when it comes to the cost of groceries back in August of 2022, which then we saw the cost of groceries increase 13.5% year over year. Now, that sigh of relief, particular to eggs. We're here with some good news for all egg lovers. They can start to rejoice as those prices start to crack. Throw in every bun you can. But month over month, egg prices declined 13.8%. Now, that's the largest monthly decline when it comes to the price of eggs in 72 years. The last time we saw this large of a decline was in 1951. As you saw there, egg prices year over year dropped down 0.4%. Now, in addition to that, when you take a closer look at the cost of a dozen large grade A eggs, you'll notice the difference there. Right now, as of May 2023, they cost about $2.66. And Rochelle, that's compared to January of this year, where that same type of eggs costs $4.82. And so hopefully shoppers will take note and start to see some prices dropping there.
Love to see that, because we just kept seeing those egg prices just keep rising there. Oh, a lot of that tied to the avian flu and some of the lower stock that they had to provide those eggs. So, Brooke, then did any other grocery categories decelerate prices in May? And what else stood out to you?
Yeah, well, year over year, we saw 5 out of 6 of the major food categories see a deceleration. Now, once again, that's a slower rate of inflation, not necessarily a decline. But taking a closer look, we saw cereal and bakery products up just a tick, up 0.1% month over month. And that was brought lower by fresh biscuits, rolls, muffins. But floured and prepared mixes, crackers, cracker products in general still are seeing an uptick. Moving right along to the meats, poultry, fish, and eggs category. Once again, we're seeing eggs drive that category lower. Also bacon driving that category lower on a monthly basis, but uncooked beef roast and fresh whole chickens seeing higher prices month over month. Dairy prices were driven lower by ice cream and related products. That was down about 2% as far as ice cream goes. Non-alcoholic beverages also seeing a slight uptick there, but once again, decelerating compared to last month. And other food at home, we're seeing this as a somewhat persistent inflation category, with sugars and sweets rising 10.2% year over year, up 0.4% month over month. Margarine also keeping a close look there. We're seeing that category up more than 20% year over year. But right here, fruits and vegetables, and that's a largely volatile index, and it tends to vary based on season, based on weather conditions, particularly when it comes to fresh fruits and vegetables. And as we saw there, it's up 1.4% on a monthly basis, largely seeing an uptick due to the cost of apples as well as lettuce.
I appreciate that breakdown of all things grocery and food for us in that CPI data. Brooke De Palma there for us. Thank you so much. Well, what goes up must come down, then probably up again. Apple hit an all-time high yesterday, closing in on a $3 trillion market cap. But a downgrade from UBS leaning on shares today. It sees weaker demand ahead for iPhones. Bullish analyst ratings on the tech giant now sit at a 2-year low. But regardless, the landmark close means Apple stock is up over 40% this year, outpacing the red-hot Nasdaq 100. The valuation means the iPhone maker is now bigger than almost any stock market in the world. Let's see what Dan Ives makes of all this. He's Senior Equity Research Analyst at Wedbush. Good to see you, Dan. So I want to get your take on this. You too. This UBS downgrade from buy to neutral, looking at this persistent softness in the iPhone and services growth, and really seeing unfavorable risk reward there.
Look, I think many have bet against Apple this whole year. I mean, from 125 onward. And look, I just think valuation downgrades in this type of cycle that we're going into iPhone 15 And what I view as just a green light for tech. I think valuation downgrades in $3 get you a cup of Dunkin' Donuts coffee.
So with that in mind then, what rating do you have right now on Apple? And what's your price target? What's your 12-month price target?
Yeah, we're 220. I mean, it's a top pick because in my opinion, we're going into a mini super cycle. And I think what's starting to happen now is cook the tactician services is continuing to increase. And I can tell you from being in Asia for a few weeks, checks continue to be extremely bullish when we look at what's really around the corner, an iPhone 15. I think when I look at this quarter, I mean, this is the appetizer before the main event. I still think many investors are offsides in terms of sort of being neutral to underweight on Apple. And I think this is just going to be a golden period for Cupertino yet again.
I mean, we did see all this fanfare, especially, looking ahead to what could be the next iPhone. And then, of course, the mixed reality headset coming out as well. But what should we be thinking in terms of, will this be as big as, say, the Apple Watch in terms of some of the projections that we're seeing? Or is it really too early to sort of have that kind of optimism yet?
Look, I think many investors, knee-jerk, they view this $3,500 AR, VR. I believe they sell 150,000 units first year out. And obviously there's, I think, subpar sort of expectations. I think that's missing the point. I think this is really around the developers, what's going to be a new form factor. And it's the start of what I see 12, 18 months down the road of an AI app store for Apple. And I think that ultimately is really where the breadcrumbs are leading. And this is an Apple, they always keep it close to the vest. And I think this is just the start of a much broader strategy with an install base, 2 billion iOS devices, that's unparalleled. And I think that from a sum of the parts, just going back to your valuation comment, sum of the parts, we think services is worth 1.4 trillion, which is why, to get off the Apple story here, I mean, those are like the same that were negative on Manchester, City, as well as Denver Nuggets going into, this year.
You're breaking my heart here with Man City. I'm an Arsenal girl. That it's stinging already. So thank you for twisting the knife there. We are looking at bullish analyst ratings on Apple, sitting at a 2-year low. What do you think they're missing in the story right now? As they're looking at where Apple is now versus, as you say, the future when it comes to some of these, what could be an AI app store for Apple?
I think the New York City cab driver was bearish on Apple coming into this year and broader tech. I think what they're missing is what the install base opportunity, 250 million of 1.2 billion, haven't upgraded their iPhone 4+ years, services upticking, the sum of the parts now starting to play out. And I think AI ultimately could add $30 to $40 per share. And then you look at that, the chips. I mean, you look at M2, I think that's probably one of the most undervalued innovations coming out of Cupertino, more and more control over their ecosystem, which is why I think Apple continues to be a rock of Gibraltar tech stock that goes higher. We have 3.5 trillion is what I view as fair valuation. I believe this is a $4 trillion market cap by 2025.
And so, and as we've seen this narrow tech rally start to melt up, start to sort of trickle into, some of the broader equities here, how much of a bellwether do you think Apple is when you're trying to sort of look ahead to the broader tech story here?
I think this, along with Redmond, Microsoft, obviously, NVIDIA, Google, clear bellwethers. And I think it's going to broaden out. I mean, the Fed basically having to wave the white flag, pause, and then I believe ultimately cut 6 to 9 months. That's a risk-on rally for tech. And I think bears continue to go into that hibernation mode, even though it's summer. And I think tech continues to rally another 10 to 12% into the rest of the year, despite many yelling fire in a crowded theater.
I will never tire of your analogies. Dan Ives, always great to have you on, Senior Equity Research Analyst at Wedbush. Take care. All right, coming up, we've got more market coverage ahead, and we'll be taking a look at how inflation is impacting rent with Yahoo Finance's Danny Romero. JP Morgan's Marko Kolonovich believes that the move in cyclical stocks may be too weighed by pressures in monetary policy tightening and future rate hikes. Let's go now to our very own Jared Blickery to learn more about that. Hey, Jared.
Hey there. Well, they call him Dr. Market for a reason. That is Marko Kolonovich over at JP Morgan. He had been spot on a number of tactical calls and also longer term calls until about the beginning of last year when his calls became less reliable. That was the onset of the bear market. And here's the S&P 500 year to date. Let me just broaden this out so we can see going back to that peak high that we actually had on the first trading day of 2022. If you look here, we have now exceeded the August highs, but essentially still in this huge trading range that goes back about a year. And to the upside, we could definitely go further. However, it is getting a little bit stretched. Whether or not you think it's going to go straight up, longer term, or down or sideways, probably in for a little bit of a pause here. But what Dr. Market was talking about is the rise in cyclicals that we've seen since that payrolls report just about a week ago. And here's a 1 month view of the sector action. We can see tech, consumer discretionary, and communication services, all those mega cap sectors outperforming. You take a look at the last 10 days and it's kind of a different view. We still got XLY, that's consumer discretionary, home to Amazon, but also a bunch of other retail names. That's up 8%, but then XLB, that's materials, up 7%, industrials up 6%, energy 5%, real estate 4%, financials 4%. This is really about the value and cyclical play here. And so what do we have happening? We have a huge Fed meeting tomorrow, and regardless of whether or not the Fed pauses, Kolonovich believes that the Fed is going to raise rates later in the year. The worst is not over. So he thinks the people that think the worst is behind us, that they will be, quote, proven wrong. So something to keep in mind here, Rochelle.
All right, a fair warning indeed. Jared Blickery there for us. Thank you so much. Well, as part of our week-long series on real estate, the new reality, we're checking, is rent still too darn high? Well, the latest inflation read shows that rent inflation is stagnating, although it still remains hot. In May, rent increased just 0.5% compared to April. Meanwhile, apartment demand is ticking up into positive territory on the heels of new supply. Yahoo Finance's Danny Romero joins us live with more on what's ahead for rents. So, Danny, what are you watching?
Rochelle, don't expect too much of a rent break, especially here in New York City. The average rent is around $3,700. That's reaching a new level. That's what Street Easy says. But outside of New York City, demand is up. There is new supply for apartments. Occupancy levels are steady. They're around 94%. But it is hard right now for landlords to retain tenants. Why? Because there's so much competition out there. There's a lot of supply in the market. The bigger challenge, though, ahead this year and next year will be the fact that this new supply is on the market, but it's going to be mostly catered to the higher end tenant. So that really doesn't tackle the affordability crunch that we are dealing with right now. And so affordable housing could come to the market. They say, some experts say that it could take between a few years for that to really roll out. But the issue at hand, if you take into consideration land costs, construction costs, those start to go up on the higher end spectrum when it comes to the totality of building a new housing structure. So it's finding that middle ground where you're able to, meet the needs for the investor, but also for the tenant. So it could take a few years for all of that to roll out. But some areas where the U.S. is really dealing with limited supply is the Midwest, the Northeast, which they have had really high rents there. But 8 major regions so far have reported rent cuts. That is Vegas, Tampa, and Phoenix. So some of those pandemic boom towns that we have really seen. But like you said earlier, CPI inflation really showed a different picture due to the lagging effect that happens with that index. Rochelle?
And are we seeing a sort of change? We know that households sort of shifted and changed during the pandemic. Are we seeing a change in sort of the size of apartments? Is it still like the one bedroom that's the hot one to buy?
Yes, I mean, occupancy level is steady. It's at 94%. So obviously demand is still out there. So whatever is out in the market, people are really being enticed by it. Yes, I would say if depending on where you are looking for rent, that also plays a part, Rochelle. So if you're looking for a studio apartment in New York City, it might be a little smaller than looking for a studio apartment in the Midwest. But yes, I mean, the fact that occupancy level is almost hitting that 100% really shows that demand is out there. People are really looking for that deal, and especially getting a bang for their buck when it comes to signing that lease agreement. Rochelle?
Indeed. Appreciate that update. Our very own Danny Romero there for us. Thanks so much. Right, policymakers in China, the world's second largest economy, are trying to spur an economic rebound ever since lifting zero COVID policies in January. As we take a look at that, we see that according to Bloomberg News, the stimulus proposals include a dozen measures designed to prop up areas such as real estate and domestic demand, and even more interest rate reductions. Now, these new steps would follow China's decision to lower bank deposit rates last week, along with tax incentives and credit support to bolster the car markets. Also taking a look at the economic instability, that could also have major impacts on the number of investors in China. A new report from Henley & Partners suggests that China will see the biggest net outflow of millionaires this year, losing over 13,000 high net worth individuals with more than 1 million invested in the Chinese market. All right, coming up, Salesforce is betting big on AI. Brian Sozzi sat down with the CEO, Mark Benioff. More of that next. The talk of the town is AI, and Salesforce is going all in. The cloud company announcing a big new generative AI enterprise at its AI Day on Monday in New York City. Yahoo Finance's very own Brian Sozzi attended the conference and got to check out some of the new technologies firsthand. He also spoke to Salesforce chairman and CEO Mark Benioff about this moment in AI for businesses. Take a listen.
We've seen a lot of exciting waves of technology in our industry, the cloud, social, mobile, but this AI wave is going to be the biggest that anyone has ever seen. I think that the success of OpenAI is the point of evidence that this is going to be one of the fastest growing moves, not just in the consumer market, but in the enterprise market. And we had some of the largest, most important enterprises in the room today, and every customer is excited to get their hands on our new generative AI products, which are shipping this month.
You said something in your presentation really early on that said, this is the new Salesforce. What did you mean by that?
What I mean is, we've been very focused over the last 5 months of transforming our financials. We just delivered our highest margin ever. We are extremely excited about our new management team that we've introduced last week, and now a whole new product strategy as well. And I think the right combination of financials, people, and technology is the right capability for this software company, which has become the third largest software company in the world, and is really just getting its, sea legs when it gets to the next generation of artificial intelligence.
I saw a lot of presentations or a lot of screens up there on GPT this, GPT that. How will that change Salesforce, and what does the order flow look like for those products?
Well, about 10 years ago, I had my first existential freak out about AI, and I ended up buying a lot of companies and assembling teams and making things happen, and that was very exciting to me. And this is bigger, because this is now the next wave. Of course, Salesforce is already a leader in AI CRM. Because of that, we introduced Einstein in 2016. We're doing 1 trillion transactions a week of Einstein. Now we're going to enter generative AI as well. I think it's going to be another wave. The amount of data that we already see being entered into the system through our data cloud is at record levels. So I think it's an indication of how well these generative AI systems will do.
I think a lot of folks on Wall Street, they're interested in how does Salesforce monetize all this amazing new technology? How do you see that?
Well, today we introduced all kinds of new monetization models around generative AI, including our AI Cloud, which is our starter package to help customers move forward. It's $360,000. It gives you all the licenses and capabilities and services to get going. I think for a lot of customers, trust will be the most important thing. They're going to want to make sure they don't have any data leakage, that their companies and their employees are properly trained to work in this area, and that all of the corporate playbooks and customer data sets aren't going out the left window. So that's our job, to make sure that the company's architected correctly and ready to go for this new generative AI era.
You seem very passionate about trust and doing AI from an ethical standpoint. Do you anticipate some form of global regulation here at some point?
I think trust and generative AI are going to go hand in hand, and then responsibility and generative AI. I think this idea that AI is kind of at a next level is true, and I think every business and every government and every individual is going to have to come up with their own way of looking at this technology and what is the right way to manage it.
Do you view AI as job creating?
There's no question that AI is going to create more jobs. It could also take jobs. It can be a balance. In the work that we showed today, which is something that's been going on for 18 months with Gucci, we've actually seen the Gucci call center expand, because what it did was it made their employees more capable, in their own words, to augment their call center. Now the call center, which only did service, also can do sales and marketing and commerce as well. That's a big step forward. They call it Gucci 9. It's like a next generation capability, and I'm excited to go to Milan and see what's going on there. It sounds expensive.
It sounds expensive. How important is it? It wasn't lost on me that you're in this room, you're a co-founder, Parker was in this room, co-founder, that Salesforce is founder-led at a moment like this. How important is that from
Founders can go faster, you're 100% right, and I think that we've transformed the company a lot in the last 5 months. We go back and look at the interview we did 4 or 5 months ago. The interview we're doing now, the questions are different.
Old, but yes.
The questions are different.
Yes.
The position is different. Everything is different, because we've transformed the company in a relatively short amount of time, and we're excited about where we are and where we're going.
How has that the past 5 months changed you as a leader? Because you're always very passionate about this, but there was a different level of focus here today, and I don't know, it was really cool to see you in that zone.
Well, I think number one is we've really focused on changing the financials. And you saw we just hit our highest margin levels. We've increased margins by 1,000 points. That's tremendous for our investors. We just hit some record cash flow numbers. You reported that as well. And very excited about the quarter we just delivered. Number two is we brought back some great leaders. We had our new Chief Marketing Officer here today, Ariel Kelman. Of course, Ariel has worked for Salesforce for 6 years, running product marketing. Then he went to AWS, where he was the CMO for 8 years. And then he went to Oracle as the CMO for 3 years. So we're very excited to have him back at Salesforce. But also, we have a number of new executives that we're very excited about, and augmenting also our Chief Operating Officer, Brian Millam, giving him some great new capabilities, including leading our business technology team and our HR team, as well as our marketing team.
Does it take time for these this next generation of leaders to settle in? How do you think about it?
Well, I just brought back my former Chief Marketing Officer, Kendall Collins, as my new Chief of Staff, and it's been great for me because he already hit the ground running. He had been with Salesforce for a dozen years, left for a few years. Bringing him back, he was able to hit the ground as if he never left. And that's the kind of executive I like right now.
You also talked a lot about a dinner you had with OpenAI, Sam Altman. And one thing that blew me away was your voice was replicated, I guess, at that dinner. Tell us about that. And as a tech leader, that had to blow you away.
Well, we're seeing generative AI do a lot of amazing new things, and you're going to see this concept of being able to create deepfakes, audio, video, the ability to do things rapidly. But as I mentioned, where is this data stored? It's not stored in a file. We all have seen like an MP4 file or an MP3 file on our phones, but that's not how this data is stored. It's stored in these weights inside these neural networks, and it's not the traditional enterprise storage mechanisms. So we're going to have to find these new ways, like we introduced here with our Einstein GPT trust layer, to store these things safely and correctly with the highest levels of trust in production.
Is there a societal risk to that? If my voice is replicated and goes out there on social media, what does that do?
Well, I think we realize that we're in a world now where AI is able to do things that we've only seen in movies. The Minority Report was partly written by a Salesforce employee, Peter Schwartz, and I think we all remember that from our childhood. We didn't think it was going to be our present moment reality, but it's turning out to be more like the Minority Report than not.
Mark Benioff, Salesforce CEO. It's always a pleasure to get some time with you.
Thank you.
Thank you so much. I appreciate it. Thank you so much.
Best. Thanks so much.
Thank you.
It will come as no surprise that artificial intelligence is making its way into the financial services industry. But would you trust an AI to give you financial advice? Well, a new Yahoo Finance poll suggests that 2/3 of investors are unlikely to use AI financial advisors. However, the younger the investor is, the more likely they are to be open to using an AI financial advisor, as 20% of Gen Z responded positively, where compared to only 9% of baby boomers. Well, let's dig in further with Ritholtz Wealth Management Director of Institutional Asset Management, Ben Carson. Ben, thank you for joining me this morning. So, as we look at this sort of some differences across generations, but for the most part, people don't seem to be sold on some of these AI financial investment tools. Why do you think that is?
Well, a big piece of the financial advice business is based on trust. And I think people have a hard time trusting their life savings and huge financial decisions to a piece of technology, especially one that's still relatively new.
And I want to ask, because a lot of these investment banks or financial platforms, they have robo-advisors. If that's sort of automated, you can sort of set it and forget it depending on your risk tolerance. But what does this level now of having AI financial advisors add to the mix?
I remember when the robo-advisors came out, a lot of people thought, are financial advisors in trouble because we now have this automation piece that can do the portfolio management for you. And I think what people realized very quickly back then was that a portfolio itself is not really a plan, right? That's just asset allocation, and that stuff becomes sort of a commodity. And I think AI is going to be kind of similar when it comes to information. In the past, it used to be that maybe the advisors had way more information than regular people and regular investors, but now that information is becoming a commodity. So it gets back to the decision-making framework. And unfortunately, when it comes to making big financial decisions, there's rarely any black or white, right? Should I save my money in this vehicle or that vehicle? Well, it depends. Should I pay down my mortgage or invest more money in the stock market? Well, it depends. How much should I take out of my portfolio each year when I retire? Well, it depends. And so thinking through a lot of those gray areas where there isn't really a right or wrong answer, that's where advisors come in to help people make better decisions. And I think people realize that it's going to be hard for technology to displace that.
And when you look at some of these chat GPT versions of it, that we know that JP Morgan has patented its own sort of index GPT, still waiting to see how that will play out, obviously. But when you think of some of the companies that are getting into this, it can be a little bit difficult if you're a consumer trying to figure out how much you should rely on as an assistive technology versus, say, a bit of advice and you sort of go your own way with it. How should people be approaching this when they're trying to pick some of these AI financial advisors?
That's the hard part, really, is we have so much information available at our fingertips now, is that the filter is going to become more important than ever, right? Everyone has access to, all this information that people in the past would have just couldn't even dream of. And so now I think it helps to have someone who can actually take that information and distill it to make sense for your specific circumstances, where you are in life, how much money you make, how much you need to save, how much you have saved, all these other things. I think putting it in the correct context and making perspective around it, that's the big thing. And you're right, it can be, investing in itself is already an overwhelming process for people. Now, if we have all these other tools and machines at our fingertips, I think it's going to be hard for people to know who to trust. So that's where I think the wealth management industry and advisors can actually help, is by providing some sort of filter for the fire hose of information that everyone's going to have available to them.
It really is this fire hose of information, because even when you look at ChatGPT and these AI prompts, this very sort of specific questions that you have to put in to really get the most accurate results, this is something that the average person is not thinking about. They're sort of putting in some sort of short and sweet question in here. How important is it then going to be to have to learn things like AI prompting to be able to sort of get some of these optimal results out?
It's difficult. I don't know how to do AI prompting yet, I guess. But I think that's one of the reasons that's kind of the benefit a good advisor can provide. They know how to ask the right questions. They know how to listen as well when it's important to understand what someone is going through and what they're worried about and what they're thinking about. And I think that's where the human element comes in. I do believe that this information and this technology will only make advisors even more beneficial to people, because they'll know what to pay attention to and what to ignore, and the right questions to ask and the right things to focus on. I think that's the hard part for most people when it comes to making financial decisions, is understanding, like, this is the stuff that's really important for you to pay attention to, and you need to ignore all this other noise because it's not going to be very helpful to you. That's going to become even harder and more challenging. So I think advisors might even become more important in this world of AI.
And so then as you look at some of these companies that are weighing in on AI and big tech in general, then should there be some sort of responsibility? People already are struggling with financial literacy. When you add this sort of AI aspect that could potentially, if there's a company that takes out the human aspect of it and just has the AI focus, sort of that worry about culpability when you already don't have people who are fully financial literate jumping into some of these things.
Could be, and I actually do think that this technology will help people on the young end. So you showed in your survey there that Gen Z are the least likely to want an advisor and more likely to trust an AI. I actually think for young people, most young people don't need an advisor, right? So I think because their life isn't complicated enough, they don't have estate planning issues, they don't have as much insurance issues, they don't have as much tax-related planning to do in most instances. So I think young people, this can really help, hopefully answer some of their big questions, because again, it's so overwhelming. Do I put my money in a 401k or an IRA? Do I save in stocks or bonds or cash or real estate? All these different questions. I think maybe that AI as a baseline layer could help people answer some of those questions who are just beginners and trying to figure out what is the stuff I really need to pay attention to. Because most people, that's where they get stuck in the process, is just how do I even begin?
Right, exactly. But at least an interesting use here for AI financial advice as a starting point. A big thank you there, Rit Holtz, Wealth Management Director of Institutional Asset Management. Ben Carlson, thank you so much. Well, that does it for now. I'm Rochelle Kufa. I'll be back with you at 11 a.m. Eastern tomorrow. See you then.